There's a lot of participation going on right now.
It could be a more volatile beginning into the year, and then it should calm down.
We're going to see a slower economy, but I think that companies continue to view labor as a scarce resource.
Our base case is still continued slowdown on the labor market side in the U.S.
We got to get a soft landing, not only in inflation, but also the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's wrap up a crazy month in November. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. This morning on the equity market, up 0.2% on the month. A major move. The S&P 500 up by 8.5% month to date and poised for the biggest monthly gain of the year so far. Lisa, the equity market move's impressive. Let's talk about the bond market move. 10-year yield down 64 basis points in the month of November.
When you take a look at the U.S. aggregate index of bonds, you're looking at a 4% gain for the month pretty much. You're looking at the biggest monthly gain going back to 1985. So here's the why. Is it really just disinflation, or is it that the economy is rolling over? Do we hit the threshold where all of a sudden the bond rally is no longer such great news for the stock rally? We have seen that for November, that it has been a wonderful Goldilocks story. Does it start to shift?
Based on this move, 5100 Binky Charter, Deutsche Bank, sounds conservative. Based on this move this month, 5K over at RBC, 5K over at Bank of America, drumroll, JP Morgan, puts out their outlook for 2024. Lisa, 4,200 price target with a downside bias.
So this is somebody, I was looking at the analysts who put this out, and it's a team that has been wrong for 2 years in a row. Let's just put that out there, to be completely honest. But they're talking about what I would agree with, which is the elephant in the room. How quickly is the economy slowing on the other side that's fueling some of the disinflation that we're seeing? That is the big mystery. Right now, people are in this Goldilocks period where they don't have to think too much about that. But the rationale is not outrageous, and I would argue a lot of people would agree with it.
Let's work through the rationale. Current valuation is rich. Tick, I think a lot of people would go with that. Here's the quote. The market is assuming a near perfect landing with inflation cooling without a significant impact to demand and pricing power. I think a lot of people would go with that. Absent rapid Fed easing, here's the meat of it, Bramo. We expect a more challenging macro backdrop for stocks next year, with softening consumer trends at a time when investor positioning and sentiment have mostly reversed. A lot of that has reversed in the last month.
I would agree with that. I would also build on that, saying that the beige book yesterday, which I know you read in detail, I know that Tom is off today reading it in
Tom's
detail
off
as
reading
well.
it right now.
Exactly.
Yeah.
He's going to spend the whole morning doing it. Really pointed to this weakness. And to me, I thought that was really telling, because these anecdotes seem to be driving a lot of Fed policy in a much more significant way. People are feeling concerned. They bought during Black Friday and Cyber Monday in part because of the discounts. And people are taking notice.
Things are slowing, and you see that in the beige book, to your point. The key quote in all of that, demand for labour continued to ease. Most districts reported flat to modest increases in overall employment. Then you look to next Friday, 2 Fridays away, next week. The payrolls report still expected to come in close to 200K.
And this is going to be a question of either labour hoarding, backward-looking indicators, or we're all getting it wrong, because right now the divergence between goods and services continues to spread. People are not buying as many goods. People are still flying around. They are still going to restaurants. They are still doing things and getting manicures or whatever else, what other services they prefer. To me, this is the big question, the quandary heading into next year. Do we see ongoing disinflation without services rolling over?
Bramo, I love you, but you might not get a job at China International Capital Corp. Did you see that story? Do you see that story? This is my favourite story this morning, and I was going to wait until later to read it, but I'll share it with you now. Analysts are barred from sharing negative comments about the economy or markets in both public and private discussions. Do you like that? Would that work for you, Bramo? An analyst over in China unable to offer any negative analysis whatsoever on the economy or markets?
Are you just trying to bait me? Yes, you are. You're trying to bait me. I do love the story. Partly because what does it mean to be negative? To be skeptical? I mean, isn't that what analysts should do? Isn't that the goal of Wall Street rigor, is to basically take a look at the facts and question where there could be holes in them? I'm sorry. They also say that employees should avoid wearing luxury brands or revealing their compensation because of concerns about sort of moral
hedonistic lifestyles.
Yes, hedonistic lifestyles.
Hedonistic lifestyles. Here's the key question. That's China. That's expected. What about Wall Street banks? Can they offer any negative analysis on China when they're trying to do business there?
Controversial point.
Yeah.
A lot of people would say that there's a lot of self-censorship, and when there isn't self-censorship, there is other types of censorship. There's a real question at a time when there's a lot of confusion around the Chinese economy. I don't know the answer to that, and I don't think anyone does. We've already heard from Bill Lee over at Milken that there is a lot of self-censorship. He's pretty vocal about this. It's a tough time to get a clear read on an economy that is really struggling.
We'll get the BlackRock view on all of this in just a moment. We won't.
I'm sure he's
Russ
just
Koster's
thrilled.
going to join us. Don't worry. Russ, we're going to talk about markets stateside. Equities right now, the scores look like this on the S&P 500, just about positive on the session, up big time on the month. We'll talk about the month of November throughout this morning and look ahead to the month of December. In the bond market, yields are higher on the session. They are much, much lower on the month. 429.55 on a 10-year, up by 4 basis points. In Europe, we can sit on this just for a beat. Inflation, downside surprise. Now we're talking about rate cuts at the ECB. Lisa, euro dollar, 109.19.
So this is what I find interesting. The ECB and, frankly, the Fed got it wrong in terms of how quickly inflation was accelerating and how long it would last. Are they also getting it wrong with how quickly it's coming down? And that's really a question for the ECB. The fact that it came in so much more than expected to the lowest rates, I believe, going back to the beginning of 2021. That's what we're all talking about. That is our new benchmark in terms of the slowing pace of inflation. Does this mean the last mile is going to be easy to accomplish? Does it come with a more significant slowdown, which we saw in France, than people had previously expected? We don't know what we're on the precipice of.
They're conditioned by the first mistake. Without a doubt, they're conditioned by the first mistake. They were blasé on the way up and they're nervous on the way down.
Which raises a question about whether they're going to be a little bit skeptical about how quickly to cut rates. What we're going to look at today is the ongoing story of disinflation, perhaps personal income and spending, as well as core PCE and initial jobless claims. We'll talk more about the jobs market later. Core PCE may come in at the lowest pace since, drumroll, early 2021. How much are we looking at disinflation that has legs versus just simply year-over-year comps that will get more challenging come next year? Today, OPEC Plus is going to meet virtually. All the delegates, or a lot of them, are at COP28, sort of an interesting juxtaposition as they're talking about the increasing demand for fossil fuels at the same time that they're trying to cut carbon emissions. I am curious how much more steeply they're going to cut production than previously expected due to a fall off in demand, as they've been talking about. At 9:15 a.m., New York Fed's John Williams is planning to speak. It has new interest to me, actually. I want to see if he actually gives any indications of the parameters for rate cuts, John.
The language has changed. Just a subtle shift, right? Started with Governor Waller. I'm with you. Let's see if we hear it from Williams and hear it from Powell tomorrow.
That basically all that they need to see is inflation going roughly back down to target, and then they can be more aggressive with rate cuts.
So let's get the conversation started. Joining us now is Russ Koster, Global Allocation Fund Portfolio Manager over at BlackRock. Russ, I'll park the China stuff. We'll focus on things stateside. Massive move higher in the equity market anytime this month. Up 8.5% on the S&P 500. Big move lower in bond yields. Russ, talk to us about how you've participated, made some moves in the last 4 weeks.
Well, good morning, John. You know, we have been raising our equity beta, and as you point out, this has been an extraordinary November. And you know, the S&P, you mentioned the numbers. If you look at other parts of the market, if you look at small caps, semiconductors, early growth, they surged even more. Now, what's going on? I think there are a couple of things. The first, the obvious one, is the rate environment changed very abruptly from where we were, 5 weeks ago. But the other thing that's worth noting is that this snapback is coming after an exceptionally weak period in August and September and October, not just for stocks, but also for bonds. So a lot of what we've experienced is a reversal. Now, we think this can continue for a bit. We brought our equity allocation higher after being close to neutral for much of the summer. And what is going on is you've got an environment where rates are coming down, inflation appears to be moderating, but there's still not evidence, or at least not a lot of evidence, that the economy is going to slow so quickly that you've got to really be concerned about a recession in early 24. Our view is the economy is slowing, but it's relatively stable, and we're going to see growth into the first half of next year.
If that's the case, what's your bond market call?
Bond market, I think, is a little bit trickier because, again, you've already had this massive adjustment in yields. And I think there are two things going on here that you have to watch. The first of which is short-term rates have come down an incredible amount. 2-year real yields are down, I think, about 80 bips from their peak earlier this summer. So you've already had a pretty significant move. Second, as you mentioned, a lot of people are starting to think the Fed's going to have the latitude or the desire to cut in the early part of 2024. We're a little bit more skeptical about that. Still think cuts are more likely in Q3 than Q1 or Q2. And then finally, as we've all been sort of wrestling with the last few months, we still have an environment where bond issuance is at a record. So even if the Fed does start to pull back and they're not as worried about inflation, you do have to think about what is the effect on the long end of the Treasury curve of all of that supply.
Is this a good scenario for risk assets? Because honestly, a lot of people would listen to what you're saying and say, well, you don't have this sort of tailwind from Fed rate cuts, but you do have the hangover of just generally slowing growth and people reassessing exactly how much potential there is in the economy.
I think it's an environment that can still produce, decent equity gains, but it really depends on what part of the market you're looking at. At least I completely agree. But it's very hard to argue the economy is not going to slow, particularly from that very heady pace of growth we had in Q3. The consumer is starting to moderate. Again, we don't think we're looking at a pre-recession. We are looking at a slower labor market and probably more modest consumption. So then the question is, what's going to do well in that environment? It may not be the deep value, which tends to do well in an environment where growth is accelerating. It probably isn't going to be a continuation of the small cap rally. But I do think some of the stable growth names, some of the quality names that generally do better, at least on a relative basis, in a slowing economy, I think they can move higher.
If you really don't think the market is getting it right in terms of how much the Fed could potentially ease next year, how much are you leaning against the bond rally that we've seen?
Well, it's not that the Fed can't ease next year. I think the debate right now is when are they going to ease? In the notion that they're going to go very quickly into an easing mode in early 24, that may be a bit optimistic. But I do think you have an environment that is going to be much more friendly. So, what have we been doing? We've been bringing our duration up in the Global Allocation Fund. We're much closer to benchmark than we've been for a long time. A lot of that buying was in the short and the intermediate part of the curve. And you think about, being opportunistic. You're going to get back up in yields. You're going to see these episodic movements in the bond market. Can you use any backup in yields to add a bit and slowly bring back towards a more neutral level?
We've talked about this before, Russ, but let's wrap it up here. If I'm sat in T-bills right now, a lot of our audience still is. In 6 to 12 months' time, how do you think they're going to feel about that decision? Regret because they didn't lock in yields at the longer end? Or are they going to be happy with that because they can allocate to the equity market, to your point, selectively and when opportunity presents itself?
I think what you start to do is you start to put that money to work. I mean, again, it's never the case that the market signals all clear and you go from being 100% cash to 100% invested. There were good reasons people were sending this out in T-bills. But the reality is we still have inflation running above the Fed's target. So your real yield is not quite as good as it seems when you just look at the nominal yield. There are opportunities in equities. And I think it's fair to say a year from now, if all you're doing is rolling those T-bills, you're going to be getting a lower level of income. So starting to put that money to work, whether it's in parts of the bond market that look interesting, or again, slowly buying back into equities, thinking about the parts of the market, whether it's healthcare, parts of technology that are going to be more resilient as the economy does moderate into 2024.
I was asking that question just for TK.
I know.
Sitting at home.
I know.
Watching this morning. Russ, good to catch up. Good to see you, buddy. Russ Kostrup there
Jeff.
of BlackRock. Thank you, mate. Let's talk about the big move yesterday. GM. General Motors with a move of almost 10%. Biggest one-day pop since January 2021. Going into yesterday, $40 billion name. And they come out with a $10 billion buyback, Bramo. This stock absolutely surging.
Your interview with Mary Barra was really good yesterday, and I thought it was interesting. I thought it was interesting how she was talking about the balance between giving back some to the workers and also giving back some to the shareholders. It was sort of an uncomfortable question, but at the end of the day, she painted it as an existential question for them. Do they want a stable company?
Sure.
Key question going forward is how do they achieve that with sales growth in an area that really needs to be a more cheaper vehicle for the electric vehicle space?
Precisely. Investors were happy yesterday. What's the future of these businesses? That conversation coming up later. Next hour, Ford CFO John Lawler from New York City this morning. Good morning. Live from New York City this morning. Good morning. Welcome to the program. The scores look like this morning. Equity futures positive by 0.2%, up on a session just a touch, up on a month big time, not just on the S&P 500, on the Nasdaq 100. Double-digit gains on the Nasdaq 100, Lisa, for the month so far.
And yes, this is coming off double-digit losses, but not by much. It's gained more than it's lost, and there's a question here about how much this is just underpinned by the bond market move versus real technological advances and the fact that these companies will own our lives. I mean, at a certain point, have you gone into an Apple store, seen how much you've spent, and then been like, yeah, they're going to rule the world?
That feels personal.
I don't know, just theoretically.
That wasn't the last week at all. No, not at all. To the bond market, the FX market, off the back of the bond market, much weaker dollar.
Yeah.
Yields lower. Just wonder how quickly now that conversation shifts from the Federal Reserve to the ECB after the move we saw this morning.
Exactly what I was going to say. People thinking that this disinflation wave kind of and the greater weakness than expected isolated to the U.S. Now that it's not, now that it seems to be much more global. And the ECB, which have been saying we need to do more, we need to be doing more, and everyone's saying, no, you don't. You're actually going to be cutting more aggressively. Does that change the dynamic and make it more whippy in the next couple of months?
Isn't that the way it always is? The market tells the Fed when they're going to cut. The market tells the ECB when they're going to cut. They're not right all the time, but ultimately that's how this plays out.
If you think about it, if nobody really has a full understanding of where we are, if you think about the collective democracy of markets, if you believe that there is enough sort of free price discovery to create that, then isn't that a logical way to look?
Yeah. Janet Henry, by the way, HSBC, is going to join us shortly. We're going to catch up with her in about 10 minutes' time, so look out for that conversation. The news yesterday evening, I'm sure most of you are up to date. Foreign policy giant, Secretary of State in the 1970s, Henry Kissinger has died, aged 100. I'm pleased to say we can catch up with Norman Rule, the former senior U.S. intelligence official and non-resident senior advisor at the Center for Strategic and International Studies. Norman, first of all, to you, sir, I know you knew Secretary Kissinger. Can you just help us understand how his approach to foreign policy changed everyone else's approach for the decades afterwards?
Yes, good morning. Well, Henry Kissinger was a titanic, if controversial, figure who brought to his work a sense of the importance of a balance of power. He was a creature of a very interesting time, a Jew in Nazi Germany, a military intelligence officer in the Second World War, a scholar during the most dangerous days of the Cold War. His background in the Congress of Vienna of 1815 and that period gave him a sense of the importance of ensuring that key powers found war less palatable than engagement. And also he brought together a sense of the United States would triangulate, would have closer relations with key powers than they would with themselves to enable that process to continue. Since that time, every Secretary of State has attempted to emulate Dr. Kissinger's approach, but no one has achieved his extraordinary successes.
Henry Kissinger was a highly polarizing person. A lot of people point to the fact that he kind of rejected idealism and really was a pragmatist and really talked about the goals that you ended up achieving rather than the methods of how to achieve them. Where does that play in the strategy of foreign policy today in America?
Well, Henry Kissinger's quote on that issue, I think, probably would be a country that seeks moral perfection in its foreign policy will achieve neither that perfection nor security. And I think we see a sense of this in the United States today and in how it deals with the world. There are key core interests. There are lesser interests that can be discarded or at least put aside for the moment. And I think that's how the Biden administration is approaching the world. China, climate change, international institutions, avoiding conflicts which would disrupt the U.S. economy.
Do you think that society has shifted dramatically enough to not really go along as much with that type of ethos as it did in the 1970s? I was going to say, how much has social media changed the picture? How much has the immediate imagery? Is there some kind of shift in the population that makes that difficult?
It's certainly a very different world, but I think we need to recall that 1968 and the late 60s in general were an extraordinary time in U.S. And European society with the protests against Vietnam, the protests against our U.S. actions in Cambodia, the U.S. actions in Chile. I mean, this was also a very polarizing figure, and he was able to navigate through that period, which also included Watergate, to achieve the successes with the Soviet Union, China, and the Arab peace disengagements, which have lasted 50 years.
We now need to talk about modern war and 2023. Norman, let's talk about Israel and Hamas. Hostages have been released. 200 trucks of aid are going in every single day into Gaza. What's the argument against extending this ceasefire, Norman?
Well, the argument against extending the ceasefire would be that it allows for the survival of Hamas, an organization which continues to state that it is interested in the eradication of Israel and those who live there. So if you believe the phrase "never again" is a driver, you must eradicate Hamas, if only to move to a peace process that is legitimate. I mean, the idea of a two-state solution is certainly everyone's goal, but no one is looking for the Palestinian state to be led by Hamas. So Hamas must be removed from this equation if we are to move forward with peace and a lasting sense of security for the Israeli people.
Norman, do you have a sense of where Iran is in all of these negotiations? There was a report yesterday that Saudi Arabia was talking about maybe even giving aid to Iran if they would call back their proxy fighters, whether it was Hezbollah or whether it was Hamas, to try to create more stability in the Middle East. Do you buy into any of these things getting traction?
Well, Saudi Arabia, the Emirates, and other Gulf states have certainly attempted to achieve a détente with Iran, much as Kissinger looked for détente with Russia. And a détente, in essence, means you don't empower your adversary, but you create conditions by which the adversary is not interested in war. With Saudi Arabia and the Emirates and others, there is the issue of U.S. sanctions. So there is a limited amount of engagement in which they can put forward to Iran. Iran has multiple incentives to continue its current efforts in the region, but very few drivers for involvement in the conflict itself. And I think over time, what we're watching is that Iran is not a winner in this conflict, that its allies have not been able to change the military balance, and it risks losing its primary Sunni proxy partner.
2 words: eradicate Hamas. Norman, what does that mean in practice?
It means eradicating Hamas's senior leadership, the operational leadership, but it doesn't mean destroying 30 to 40,000 fighters who, by the way, will remain heavily armed in the post-conflict environment. And those fighters and their indoctrinated families and culture must be dealt with if we're to prevent the rise of a Hamas 2.0 or an ISIS. And in the Arab world, and I've spoken with a number of senior Arab officials, they have a concern that this conflict could produce exactly that, not only in Gaza, but in places ranging from Southeast Asia to sub-Sahel Africa. So their comment is we've got to avoid this turning into another problem, just as Al-Qaeda turned into ISIS.
Norman, you said that these fighters are still going to be there and heavily armed, that some of the sentiment and education has to be dealt with. What do you mean? How is that accomplished?
Well, there is a track record for this. Saudi Arabia, the Emirates have actually an excellent record of de-radicalization, and we've learned a lot from them as they've dealt with their own culture and the region as well. But this requires giving the Palestinian people a sense of hope, a sense of security, and dealing with the witch's brew of multiple Palestinian splinter organizations, most of which are dedicated to violence and the destruction of Israel and the United States.
With that in mind, Norman, just a final question from us. How do you expect the nature of this war to develop, to change in the coming weeks and months?
This remains a likely long-term conflict, although it will play out not necessarily in terms of a traditional war. There are so many factors in here that need to be put together. I think the United States will focus on hostages, return of hostages, preventing an expansion of the conflict, laying the groundwork for the future. But beyond that, I think we're off the map, and we should have a lot of patience and look for a lower intensity conflict that protects civilian lives while eradicating a terrorist organization.
Norman, thank you, sir, for your contribution. Always valuable. Norman Rule there of CSIS. Lisa, eradicating Hamas is something that comes up in conversation all the time. In practice, it is so much more complex. It's just easy to sit here and say eradicate Hamas. To Norman's point, there's a lot of work and effort that has to go into that over time, for a long period of time.
Yeah, and basically talking about how it's important to get rid of the senior leadership, although they're disparate, right? And they're different factions within the Hamas leadership. But then you're going to have heavily armed individuals who have been fighters. And how do you transform a society into a new ethos? It is unclear to me how this is achieved, and I think it is unclear for everybody as they try to figure out what's next.
More still to come on this programme, including a bit of a rant yesterday about certain advertisers.
That's one way of putting it.
On X. We'll be talking about that in just a moment. Not with Janet Hendry of HSBC. She'll be talking about the global economy. We'll catch up with her in just a moment. From New York City this morning, good morning to you all. Stocks are just about positive. Here are the scores this Thursday morning. Good morning. Equities positive 0.2% on the S&P 500. A lift here, up 0.2% on the Nasdaq 100. Takeoff for the month on the Nasdaq. Wow. Double-digit gain for the Nasdaq so far this month, Lisa.
And how much is this just a retracement of some of the declines that we saw over the previous few months and just on the heels of the bond market rally? And how much is this to the moon? Artificial intelligence will rule the world, and we're going to now try to hook into that, and it's got a lot more legs.
Best month since July 2022. First month of gains, actually, since July of 2023. I hadn't realised that. I'd kind of forgotten how bad it was before.
Except bad it was before. In quotes, right?
Sure,
I mean, it's
yes,
sort of,
yes,
this is the amazing thing, is that everyone was expecting this to be a dreadful year led by tech, all the way down, repricing, right sizing, all of the enthusiasm is out, and it's exactly the opposite. The question is, can it continue? Is that going to be the leadership next year? What I find interesting about all of the outlooks, they all say, yes, this is going to be the leadership next year.
Absolutely.
It'll continue.
What did Gretzky say? Skate to where the puck is going. This market is trying to skate 6 months out to where the puck is going, and they think it means a weaker economy, but not a recession. Some rate cuts, maybe, and a bond market that's supportive of an equity view, which means equities carry on rallying. It's that good. It's that simple.
Goldilocks that can continue forever.
Unless you're JP Morgan, because JP Morgan is saying 4,200 on the S&P 500. That's quite a call, Bramo. After being wrong 2 years running, to come out and say 4,200 on the S&P 500, going completely against the grain.
They're going against the grain with the equity market call. They're not going against the grain as much when it comes to what's behind that.
No, the logic stacks up.
The logic is interesting to me, and this is sort of how you can have an economic call and be right and get the market completely wrong. And we have seen that again and again. This time, people are coming at this saying, yes, the consumer's going to slow. You're going to see a real pullback in spending. Does that mean losses for equities, or does that mean continued gains, because that means that rates are lower, and that means that going forward, we're going to have a lower pace growth that's more sustainable? Stock
market bulls love this bond market, so let's talk about this bond market. 2-year, 10-year, 30-year. Your 2-year has come down from 525, 526 in October to 465.54. Your 10-year has come down from north of 5% to 429.55, even with, Lisa, a 4 basis point move on the day. And yesterday was rather like the day before. Selective hearing. Certain Fed officials, Barkin of Richmond, suggesting maybe we might have to do more. Others, Bostic of Atlanta, suggesting maybe we're done and there's more disinflation in the pipeline. I would suggest we continue to listen to the ones that encourage this bond market move and speak to the consensus view, and ignore those that are going against the grain.
And partly this is because of the disinflation that we're going to see from the PCE. It's partly because this is what people want to hear, so they will hear this. What do you feel more confident in, though, John? And to me, I've been kind of surprised that the 10 years participated as quickly as the 2-year. I mean, to me, this has been the biggest surprise. 2-year, I get, if inflation's coming in more aggressively, okay, this makes sense. Longer term, does it make sense if the issuance picture is the same? The Bank of Japan is signaling that they're going to relax even further yield curve control. There still is a host of concerns about who the buyers will be in a higher yield environment.
I'll try and make it simple. 2 years of policy call. Further out along the curve, way too many variables. Think about the logic for the move to 5%. That was a month ago. And here we are, we've got guests on this programme saying, yeah, there's reason to drop into the 3s, when we had people on this programme talking about reasons to go up towards the 6s. 1 month later, has that much changed in a month?
Well, the price has changed, so we can change our view as well. There is this issue, though, what causes it to change back? And that's what I'm going to be looking for, to understand whether it's the auctions, whether it's something else that's longer term about higher inflation for a bit longer than people expected.
Let's finish on the commodity market. So most people got October wrong, and then got November wrong as well. So October, we were down by 10.76% on crude. November, we're down around about 3%, even with this move. So WTI in the 70s. What a surprise after what we saw take place in early October.
People thought that you'd see supply constraints due to the Hamas-Israel war, due to what could have been an expanding conflict. Now we're worried about demand falling off a cliff. We're talking about oil prices continuing to go down. And now with OPEC Plus meeting virtually from COP28, there's this real question about whether they're going to cut further and whether they can get Angola and Nigeria on board.
I'm sorry, OPEC Plus meeting in COP28.
That's essentially what it is. I find that hilarious.
Let's move on. Under surveillance this morning, Henry Kissinger, the former Secretary of State who played a key role in Soviet and China relationships during the 1970s, has died. Kissinger spoke to Bloomberg earlier this year about the difference between American political debate now and the 1970s.
In the present period, the debate had shifted to extremes in which there is an extreme theory of America first, and which is applied on both sides, but in such a way that it focuses too much on American interests and not on global interests.
Henry Kissinger was 100. Secretary of State Antony Blinken arriving in Tel Aviv as Israel and Hamas agree to extend their truce by another day. The short extension allowing for the release of more hostages. Blinken saying the pause in fighting has been successful and they want it to continue. And this government, Lisa, is under pressure to make sure it does.
Yes, this is the problem, that as we just heard from Norman Rule, the objective is not close to being accomplished. And both sides have not shifted in their view. So fundamentally, as you and I have talked about extensively, nothing has changed. There just is an incentive for a pause. So what does it look like afterwards? When Norman Rule is talking about a more selective, a more surgical type of incursion in Gaza, what does that look like? How much can the U.S. get on board with that? How much pressure is there? How long does this last? These are some of the questions that people are asking.
I don't know how the Biden administration balances contradictory views. And they're contradictory views for the following reason. One, you want to stand shoulder to shoulder with Israel, who has one single aim to destroy Hamas. And we know because of the nature of this war, destroying Hamas will mean a loss of civilian life. And then at the same time, you want to make a statement that says we need to limit the loss of civilian life. Those two things are almost incompatible because of the very nature of the way this war is playing out on the ground in Gaza. So, Lisa, the pressure will continue to build to extend the ceasefire and extend the ceasefire. But as we know, at some point, there's going to be a re-engagement. The war will restart and the truce will end. And we know what's happening within Biden's party. The pressure is building and building and building, and the clock is ticking towards next year. And this is becoming a big, big election issue, and you see it in poll after poll.
And this is a reason why a lot of people think when it does resume, when the fighting does resume, it's going to look very different. And it's not going to be the same kind of big, large-scale bombing.
So we finish on a lighter story.
Please.
An expletive-laden rant. Elon Musk and the advertiser boycott stemming from his endorsement of an anti-Semitic post could kill X, formerly known as Twitter. Musk apologized for the endorsement, but speaking at the New York Times Deal Book Conference said this: what it's going to do is going to kill the company, and the whole world will know the advertisers killed the company. Go F yourself. Companies including Apple and Disney have been distancing themselves from the platform in the wake of the endorsement. Bob Iger, Elon Musk is there.
Hi, Bob.
On the stage. Hi, Bob. Hi, Bob. And towards the end of the exchange, and I think a lot of people have only watched those 2 minutes where it finishes with hi, Bob. Towards the end of the exchange, he finishes on how much good Tesla has done for the world and talks about, and I think alluded to, the virtue signaling of corporate America, who in Elon Musk's mind seems to be more interested in the perception of doing good than actually doing good. Because people love what Tesla's achieved. But the problem is, Lisa, for a lot of people, that's not the man they want running the company. And Elon Musk pushing back aggressively against that. He gets it and pushed back aggressively against it towards the end of those comments.
I'm not sure that people are going to be talking about that in part because of how he was messaging some of the things that he put out there. And I am curious what exactly he means, John, when he says that the world is watching. And if you kill X by withdrawing your advertising dollars, everyone will know and we're going to document it. What does that mean? They're going to sue them for withdrawing their advertising dollars? I mean, you can say what you want to say. He could be right theoretically in certain aspects of what he said. But at the end of the day, what feels good might not actually have legs in the legal world.
We'll talk more about this a little bit later this morning. Let's turn to the global economy. Janet Henry, Chief Global Economist at HSBC, joins us now. Janet, don't worry, we're not going to talk about that. We've parked it. We're going to talk about the global economy and Eurozone inflation. Janet, downside surprise. We've seen similar stories emerge in the United States. Do you have confidence that the next move from this ECB is a rate cut and that move might be just around the corner?
I'm pretty confident that the next move will be downwards from the ECB, but I suspect it won't be quite as soon as the markets are now pricing in. Looking at it, it seems to be there's a 50-50 chance now of a rate cut as soon as March. I think there'll be a sigh of reassurance across the ECB that they don't have to continue to tighten policy. But remember, it was only in the last few days that there was talk of bringing forward the halt to reinvestment of the PEP programme. So I think, yes, the next move is down, but more likely it still will not be in the first half of 2024. And we'll have to wait wait a little bit longer.
Do you think, Janet, that's because inflation's not going to come down enough, or do you think it's just because of the conditioning of ECB members from getting it so wrong in terms of how quickly inflation accelerated on the way up?
I think inflation is still too high. I mean, that's a fantastic print. Everyone's over the moon that we got a 2.4% print on inflation from the Eurozone. And a downside surprise in core inflation as well. But core inflation is still running at 3.5%. And also, we know that November is the trough. Headline inflation is probably, just given the base effects, going to start rising again from December. We are optimistic that core inflation does continue to edge somewhat lower over the course of the next few months, but it will still be too high, and ECB members are still watching those wage numbers. And actually, the latest print on negotiated wages, so that kind of stickiness that we often see in the Eurozone, is likely to keep certain areas of core inflation somewhat elevated. And, it's fair to say that for the last few years, remember, inflation's been above target for over 2.5 years. They know which way the risks are still skewed. If they need to, they can cut interest rates aggressively. We don't expect that. So the reaction function matters. But for now, inflation is still too high, even if moving in the right direction.
Janet, how do you understand the fact that the economic trajectory seems to be being downgraded pretty significantly as we get incoming data, even as the labor market continues to seem solid? Is the labor market not the same signal, not the same indicator that it used to be?
Well, it depends which country we're talking about. There's a lot of uncertainty about the UK labour market data. And obviously, even policymakers are grappling with that at the moment. But what we've seen in Europe, and we had further data out of Germany this morning, was a rise in unemployment. And Germany is in more of a traditional recession. The economy has been contracting for some time. But in the US, obviously, the labour market is still very, very tight. But actually, the US has seen some downside surprises on inflation as well. So I think the markets react still to the activity data. Anything weak on the labour market, particularly with regard to the US, they bring forward their expectations for rate cuts. Likewise for the Bank of England, when we got a very weak service sector PMI, it was, the Bank of England will have to cut a bit too swiftly. So I think it is the markets are struggling with is the inflation and the activity data. At the moment, the activity data aren't reviving, even if they're not deteriorating as rapidly as some expect. But it has been the good inflation news, albeit just for a month or two.
Janet, I think sometimes we talk about these central banks as if they're machines, rule-based, and you plug in some data and it spits out a call. But these are human beings conditioned by their experience, and their recent experience was to be very, very wrong on inflation. Janet, do you think that almost guarantees, because of what they've been conditioned by, that they're going to be very, very late when they have to move the other way?
Not so much that they will necessarily be late. I think you have to decide what would be a policy error on behalf of central banks. A year ago, people were saying, is the Fed going to make a policy error? And they meant, is the Fed going to cause a recession? Actually, for a central bank that has an inflation mandate, a policy error would be that they tighten policy so much that inflation falls too much. Inflation falls below their target. And remember, that was a lot of the battle for the last decade when they were slavishly trying to hit the 2% target and were keeping policy very, very loose because it was at 1.5, trying to force it a little bit higher. So I think it is, yes, all of their reaction function is conditioned by the recent past, but also longer periods of history. But ultimately, even for central banks that have got a dual mandate, the Fed's getting towards balancing the risk between activity and inflation. But more explicit inflation targeters, it is absolutely about the inflation side.
Janet, appreciate the update. Janet Henry there of HSBC. Coming up, much more on Elon Musk and X.
Technology is really changing the way we live. We all know that, but we get kind of jaded about it already. AI as it exists creates for profitability for companies, even in tough times. Overall, it says stock prices to move higher as technology feeds all 11 sectors.
Stolfus there, John Stolfus of Oppenheimer Asset Management. If there was a roundtable, a panel that I would love right now, it would be Stolfus on the one side and a team over at JP Morgan in the investment bank at the other. Stolfus and the like talking about the prospect of pushing 5K on the S&P 500. JP talking about 4,200 on the S&P. That's quite a spread.
How much does this really hinge on tech? And I say that because a lot of people are saying the rest of the market can stay basically in purgatory as long as tech continues its trajectory upward to the moon, right? And this has been the story all year. If you start to get some sort of reckoning where we understand where we are in the cycle, then it can continue that much more. You know, again, it's almost how much is this an AI discussion without being an AI discussion?
Would you like an autos discussion?
I would like that.
I think we should have that right now. I want to look at two names, GM and Ford. GM yesterday, big move higher. Big buyback, stock buyback, $10 billion worth. Hike to the dividend, all the good stuff. Stock absolutely flying. GM up by 0.75% this morning. Ford out with this. Reinstating his forecast, Lisa, full year adjusted EBIT, 10 billion to 10.5 billion. The number that jumps out for me now, the labour packed cost. These numbers are huge.
Yes.
Expected to cost 8.8 billion. I think GM was around 9, so certainly in line. But the difference is, the cost effect to be about $900 a vehicle by 2028. That's a stark contrast with what we heard from GM. That's a few $100s more.
That basically the implication here is they're either going to have to lose it in margins or they're going to be charging more for their vehicles. GM was saying they could offset it and that they had been prepared for it. So here's the question, right? Is this going to eliminate some of their competitiveness when they're facing off with vehicle manufacturers in China and elsewhere that are coming up with cheaper options? How much is the price point increasingly a question? And does it come out of margins or does it come with pushing the consumer just a little bit more?
They've put a number on the lost profits during the strikes.
Yep.
$1.7 billion. 1.7. It's a pretty punchy number, isn't it?
Which is the reason why I actually find it interesting that they reiterated their full year forecast, right? It highlights that they would have otherwise beat pretty significantly. Next year is really the question. If we do get a softening in the economy and they do have higher charges from existing labor contracts, again, where does it come from if they're struggling to move those cars and they can't finance it with cheap money because that's off the table at this point?
A reinstated forecast. Seeing full year adjusted EBIT 10 billion to 10.5 billion. We'll catch up with the CFO in just a moment. Earlier on in the programme, we were talking about an expletive-laden rant from Elon Musk, talking about X and advertisers and then talking about Tesla. Let's get to Alex Webb over in London, who joins us now, who watched all of that exchange. Alex, let's talk about it. And I want to talk about one specific angle. I want to talk about the Walt Disney Company. When Elon Musk looks into the audience and says, "Hi, Bob." Alex, if you're at the Walt Disney Company right now, and you're running, I don't know, corporate relations, PR, whatever, what are you saying to Bob Iger right now about what the next move should be?
Don't say anything. I think that, you do not want to find yourself actively embroiled in this hullabaloo around anti-Semitism, which is, frankly, appears to be the reason why Disney and others have pulled their advertising from the platform. The thing that's kind of wild about this is, the users of Twitter, of X, are not its customers. The advertisers are the customers. Now, could you imagine any other company in the world? Imagine if he had said that about people who buy Teslas. If he'd said to Teslas, use this turn of phrase, which I will not repeat, but you can find it in our story at least. If you said that to Tesla buyers, he just never would. So it's kind of wild that he's therefore saying it about his customers on his social media platform.
But there was a veiled threat, Alex, basically saying you will kill our platform and we will track it, we will document it. And with the implication there was going to be some accountability. Do you have any understanding of what that looks like?
Well, Twitter and X it's never been the key platform for almost any advertiser, right? It's a nice to have. It's a second tier in the sort of pyramid of social media platforms of it's good for brand awareness, particularly among a particular cachet, a particular coterie of users, sort of media types, people are actively engaged in the news. That audience has maybe dissipated a little bit in recent months, therefore perhaps not as appealing to get to those people anyway. It isn't the sort of thing that Facebook, Meta, Instagram, TikTok as well increasingly provides, and certainly Google provides, which is hyper-targeted advertising to people who are really likely to spend money on your products. That has never really been what Twitter and X offer. So the fact that they're pulling back from it, the numbers they're spending on this platform don't appear to be massive anyway. The pullback, it doesn't seem like it's going to damage these companies. If they pulling their business from the platform ultimately leads to its bankruptcy, I mean, that's not really, it's hard to see why that's got repercussions for them. This is not seen as a public service. It's not as though you're pulling money from, public infrastructure or something. This is a private company, so it's a very strange threat to wield.
What about for Tesla? Does this have implications for Tesla, given that Elon Musk is an increasingly polarizing figure?
We have seen some reporting around the fringes about appetite for Tesla, for their products, maybe taking a little bit of a hit because of some of their CEO and controlling shareholders' behaviors. You're not necessarily seeing massive impact on the company's numbers as a consequence. You see plenty of examples of companies where, perhaps perception of leadership or perception of the company as a whole isn't brilliant, and yet it still does exceptionally good numbers. So I think the bigger concern for Musk at this stage is his investors in X, in Twitter, right? And whether those people start to ask questions behind the scenes which could affect the way he runs the company.
That takes us to the banks. Lisa had a conversation earlier this year at the World Economic Forum in Davos with Morgan Stanley.
Yes, James.
And you asked directly about that, didn't you?
Are you going to end up owning Twitter?
What did he say?
No, we are not going to end up owning Twitter. Well, if you're not going to end up owning it, what's the potential ramification for you?
We should find that sound from earlier this year. I remember that exchange, that conversation. He referred to Elon Musk as a brilliant man. In many ways, he is a brilliant man. But it just raised the question, Alex, will the banks end up owning this platform?
I mean, it is actually, I was having a similar thought this morning. We need to think through actually what the ramifications of a Twitter bankruptcy might be. Don't forget, the banks have a slightly different game here because there are other companies that are controlled by Elon Musk, not least SpaceX, that at some stage could be looking to IPO, right? And there are plenty of banks who are going to be wanting a piece of that business. Therefore, they do not want to be getting on the wrong side of Elon Musk. He is someone who we know can appear to bear a grudge at times. So it's a tricky task for them. There is a huge amount of inherent value in Twitter, irrespective of whether it gets driven into the ground through a combination of advertisers pulling their ads and perhaps some behavior of the people at the top of the company. Namely, it's user based, and people will pay to acquire users. And I'm sure there's a long list of tech companies that would queue up to try to acquire Twitter and embed it into their own network of products for pennies on the dollar of what Musk paid for it a little over a year ago. So there would always be appetite for this business from an M&A perspective. The banks, I do not envy their position because they clearly see a huge amount of potential in business from the broader Elon Musk universe.
Alex Webb, thank you, sir. Out of London on the latest. I'd love James Gorman's thoughts this morning on this, wouldn't you?
Well, his thoughts on the record or his thoughts off the record?
Off the record,
yes,
obviously.
Yes, because on the record, he would say he still is a brilliant man. He is unconventional in the way that he goes around things. We're assessing the value of this company. I imagine that off air, his expletives might be somewhat similar to the expletives that we heard last night.
Well, given what Alex said, there is some business to be had elsewhere, right?
Yeah.
There might be an IPO just around the corner.
Okay, sure, with Starlink, et cetera. So maybe this is basically a token to get some of that business. That said, they can't necessarily be particularly happy. Linda Yaccarino, she came out and she just sort of sat stone-faced listening. She put out on Twitter her perspective, which I think is interesting. Here's my perspective when it comes to advertising. X is standing at a unique and amazing intersection of free speech and Main Street, and the X community is powerful and is here to welcome you. To our partners who believe in our meaningful work, thank you. That's what she came up with.
That's a tough seat. That's what that is.
That is a tough seat.
Let's turn to Ford. The latest on Ford just a moment ago, reinstating their guidance, a range of 10 billion to 10.5 billion. You'll remember they suspended their guidance back in July. That was previously 11 billion to 12. So a slight trim there, but ultimately, Lisa, widely expected. Ford is up in a pre-market by 2%.
It's interesting that they're lowering the profit guidance because we've been asking, which would you rather, lower margins or having to charge more to consumers? That equation was different, say, 6 to 12 months ago. Now are we going to start to see them take the hit in the margins in order to move volume and gain a competitive advantage against some of what we're seeing, in particular out of Asia?
Well, just on margins, higher labor costs at about $900 to the cost of each car, and on margin shaving them by as much as 70 basis points.
Yeah.
We'll be catching up with the CFO of Ford, John Lawler, in about 20 minutes' time. From New York City this morning, coming up next on Your Market, Michael Schall of Market Field Asset Management. That conversation just around the corner. Equity futures positive here by 0.2%. From New York, this is Bloomberg.
There's a lot of participation going on right now.
It could be a more volatile beginning into the year, and then it should calm down.
We're going to see a slower economy, but I think that companies continue to view labor as a scarce resource.
Our base case is still continued slowdown on the labor market side in the U.S.
We got to get a soft landing, not only in inflation, but also the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The best month of the year for the US stock market. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P this morning up just a touch by 0.2% on the month. Up big time by almost 9%, Bramo, through the month of November.
It didn't feel like it. That's all I can say.
Well, the bond market move, wow.
Yeah, the bond
down more
market,
than 60 basis points on a 10-year.
So the bond market move was a wow, and yet equities rallied into weaker than expected economic data, right? So this is really the question that we've been asking all morning. Is this inconsistent in some capacity? Does this have to break down? Or is this basically what we're going to see going forward, that the bond market's going to rule the world and we're all just living in it?
Well, it's ruling the world this month. Let's see if it rules the world into next year. Lisa, how polarizing is the conversation on Wall Street? On the one hand, we're talking about the fastest growth we've seen in some 2 years in the US economy, north of 5% for the third quarter. On the other, guest after guest after guest after guest having a conversation about recession a few quarters away.
Basically saying that maybe we're just not seeing the weakness. And that's sort of what Beige Book really fed into, that anecdotally there is a weakening, particularly in the labor market, and you are seeing a weakening in goods spending. But I take your point. If you annualize this, it's near as 9% GDP on a nominal level for the year for the United States economy. This doesn't scream recession, which is the reason why people are saying Goldilocks. We don't get inflation. It's back to transitory without anyone saying transitory. We were just 1 year delayed, and we're back to it for 2024.
At the surface, things look pretty decent.
Yeah.
Growth is okay. Jobless claims are still near 200K. You dig a little deeper. You go to Friday, record holiday shopping. You go to Sunday, busiest day ever for US airports. You get beneath the surface. Buy now, pay later, absolutely exploding. Credit card delinquencies are going up. That's problematic. You can tell the consumer's reaching. You look at consumer confidence, sure, improving just a little bit. Gasoline prices are lower. I get that. But ultimately, the consumers hasn't felt good about this economy. Hasn't felt good about it at all. And TK, I think, has absolutely nailed it. Regardless of what's happened with wages, on average, this is about the cumulative inflation over the last 3 years. And it hurts.
It hurts significantly when you take a look at average prices rising by more than 20% in those 3 years. So given that, does sentiment start to indicate that they're going to do something about that and reduce spending? Or does sentiment continue to diverge with what they actually do? Going forward, a lot of people are looking to next week's labor market report as the key indicator. That if we do see a real weakening on that front, then we can say that a lot of the strength is backward looking. It is bringing forward some of the spending to deal with discounts, et cetera, and that we can maybe think about something else. But that's a big if, because we haven't seen that falling off.
Jobless claims, the appetizer for that. We'll get those jobless claims a little bit later this morning. Bramo's going to go through the Canada for you in just a second. I want to go through the scores. Your equity market on the S&P 500 positive here by 0.2%. Month to date, the S&P is flying, the NASDAQ too. We're looking at double-digit gains on the NASDAQ 100 for the month of November. For yields, up this morning, down aggressively over the last 4 weeks. 429.36 on a 10-year. Up 4 basis points this morning. Only a month ago, we were talking about 5%, Lisa, on a 10-year yield.
It's a mind-boggling whipsaw, and it's come with pretty aggressive disinflation, which certainly makes sense, at least on the front end of the yield curve. Today, we get personal income and spending as well as core PCE. Very curious to see whether we see the same bigger than expected disinflation in the U.S., similar to what we saw from Europe earlier this morning. And of course, the jobless claims very much in focus with the labor market and questions there. Today, OPEC Plus is meeting virtually. And the reason why they're meeting virtually is because a lot of the delegates are in COP28 talking about removing the dependency on fossil fuels. The irony is not lost. At the same time, the discussion will be about demand coming off and potentially jawboning some of the members to effectuate greater cuts to production. This has been one of the big mysteries, John. Honestly, why have oil prices gone down so much at a time we're talking about geopolitics and we're talking about north of 5% GDP growth in the third quarter?
We're not going to get the oil embargo we might have got in the 70s. the US is less dependent on crude coming out of the Middle East. I saw a stat, I think, in Barron's over the weekend, 75% of crude exports coming out of places like the Saudi, like UAE, are going to Asia now. Asia has a very different view on this conflict. And I think given the fact that we've saw aggressive diplomacy to make sure this war didn't spread, if you woke up on the morning of October 8th, the day after that tragic terrorist attack, there was a belief this could spread. That quickly deteriorated, and crude followed suit, trading lower.
And it shows how much the playbook has changed and how difficult it is to get it right in an environment that's shifting very quickly. The Fed speakers have actually been way more interesting this week than I previously had thought. Mea culpa. New York Fed President John Williams is planning to speak at 9:15 a.m. Does he lean into the discussion that we heard earlier this week from Chris Waller in particular, saying that all they need to see is inflation get roughly down to target for them to start aggressively cutting rates? It doesn't make sense to have as restrictive of a level, given how quickly you are seeing prices stabilize.
It's quite an interesting week. We'll get Chairman Powell tomorrow, so look out for that as well. You'll hear from the Federal Reserve Chairman in the next 24 hours. With us around the table, Michael Schau, CEO of Market Field Asset Management, joins us here in New York. Morning, Michael.
Good morning.
Let's talk about JP Morgan just briefly. 4,200 price target they've got on the S&P. I wonder if you agree with this. They say current valuation is rich. The market is assuming a near perfect landing with inflation cooling without a significant impact to demand and pricing power. You on the same page as them?
I never like S&P targets, but the basic idea that everything's exactly where you want it, it doesn't kind of stay that way. I mean, I think either the economy is still okay and strengthening, in which case I don't think the 10-year is staying at 425, or we're in this pre-recession period and we're going to have a much, much weaker economy in 6 months' time, which apparently people want. And that's not really compatible with the S&P going to 5,000.
When you say apparently it's what people want, what do you mean by that?
I mean, I think there's a lot of sort of wishful thinking. I sort of feel that we've gone through this sort of 2-year period and we're exactly where we were. The market's where it was in November 2021. In November 2021, we were all convinced that the Fed could stay at nearly zero for almost as long as it wanted to. And sort of now we're sort of wishing the Fed to be able to cut rates aggressively without any adverse impact on the economy taking place at the same time. And that's an unlikely scenario. We could be in this pre-recession period. Things could get much worse from here. The Fed could be cutting rates, but that's not going to be great for corporate profitability.
So how confident are you? How much conviction are you to lean against the sort of Goldilocks narrative?
I think it's going to all be about rates. And I think that you've gone through this sort of incredible whipsaw where the long end of the curve was a one-way short bet. Now it's a one-way long bet. I think we're going to end up with the 10-year back in that 4.50 to 5% range. And I think the economy's okay. I mean, I don't think we're pre-recession. I don't yet see any clear evidence of any portion of the economy really getting into trouble. The only thing I could really point to is commercial real estate, particularly multifamily, where you do have the signs of a real slowdown in activity. But I don't think that's big enough to really represent what the single-family home market did in 2007. It doesn't look the same yet.
If it's all about rates, and you see rates staying at about 4.50 to 5% for the 10-year, does that mean that stocks are going to suffer, considering that they've gained on the heels of a pretty big bond market rally?
What it means is that you're going to need to see much better corporate earnings than people expect if the S&P is going to make progress. I don't think that let's say the 10-year at 4.75 is devastating for the S&P. But I think you'd need to grow into current valuations in that situation. You're not going to have the same fuel that you've had over the last 4 to 5 weeks, really propelling everything back up.
Who does have pricing power right now? Walmart talking about deflation. We'll talk about the auto sector a little bit later. They've been cutting prices. Who's got pricing power?
Well, it's not really deflation. I don't think the U.S. consumers, really tapped out yet. I think that you're going to you don't need as much pricing power with input costs coming down where they are. But I think if we went back into a world where commodity prices were rising and things were tight, demand was tightening, I think you would see that people still have pricing power. I think that you have changed the inflation psychology semi-permanently during COVID. It's really, the world post-COVID, post-pandemic is not the same as the world pre.
So Goldman says the hard part is over. The disinflationary tailwinds are in the pipeline. Growth can continue. Sounds like you might think the hard part is still in front of us.
I think the hard part's always in front of you. I mean, the nature of economies is they are dynamic, and the nature of economic data is that it's constantly exaggerating moves in one direction and then exaggerating back in the other. And in a sense, the worst news we can have is that we had a near perfect set of data in October, which has all been released over the last 4 to 5 weeks. My guess is that the November data will be more complicated. Either we'll see much weaker growth than we're looking for, or we'll see higher inflation numbers than we're looking for. But you don't tend to get everything lining up exactly where you want it for 2 or 3 months in a row. Even in the you look back in retrospect and say, well, my God, that was so obvious that this was happening. In real time, the data doesn't actually help you in the way that it has over the last few weeks.
I love that Goldman said the hard part is over. George Saravillas over at Deutsche Bank says the easy part is over. Or in other words, bonds up equals equities up should now be ending. This will matter for the dollar too. Michael, is that sort of your sense too? That let's say we don't get what you expect, which is a lift to bond yields going forward, and yields do continue to go down. Are we going to see a divergence where this is bad news for equities on some level?
Yeah, because I think what takes yields lower, I mean, what does it take to get the 10-year to fall back below 4%? I think it would be clear signs that the economy is rolling over. The Fed has gone too far.
2 more days, Michael.
2 more days, yes. Two, but they'd have to be big days.
I agree. Carry on, I'm joking.
So, 2 big days. I think that it would require much clearer evidence of a problem in the U.S. economy and something for the Fed to address.
You sound exhausted, and I don't mean it in sort of like a day-to-day kind of way, but it's sort of tiring to see the same narratives kind of coming back to the future 2 years from now. And this doesn't feel like there's a lot of conviction in how to push against what you see as maybe a little over-enthusiasm for Goldilocks. Is that right?
I think you spend 2 years and you end up back at the same place. It's somewhat tiresome. But I think markets and economies are dynamic, and the thing about this business is when it looks really easy, it's going to get hard, and when it looks really hard, probably something will change.
It only looks easy looking back. I always say that nothing about this is easy. It never is. And there's a phrase that I absolutely despise: the easy money's been made. It's just never easy, is it?
No, but sometimes it's easier than others.
True. So. It's all relative. Michael, thank you, sir. Michael Schau there of Market Field Asset Management. I think we're all exhausted just by the narrative back and forth. Yeah. Keep going back to James Athey, Aberdeen. Just narrative, table tennis, ping pong. It's been like the year so far, hasn't it? Hard 100%. Landing, soft landing, no landing. Soft landing Nirvana. Neil Dutta, thank you. We'll catch up with Neil a little bit later. If you're just joining us, catching up with us now, welcome to the programme. Your equity market positive here by 0.2%. A lot to talk about in the auto sector. We're going to do just that. We'll catch up with the Ford CFO, John Lawler, in just a moment. They've reinstated their guidance. So earnings now, the range 10 billion to 10.5 billion. Previous range, before they had to take it out because of this big spat with UAW, that was suspended. It was 11 to 12 billion. So that's come down just a touch. The stock is up by 1%. Notably absent this morning is a conversation about a $10 billion stock buyback, which is what we talked about with GM. Perhaps a different approach this morning, Lisa, from Ford.
It is a different approach, and we'll get more of a sense of just why that might be and their approach in just a few minutes. To me, I find it interesting, this question of how much is going to come out of margins and how much is going to come in the form of higher costs for the vehicles. You asked about pricing power to Michael Schau, and I think it's an interesting question. Is there a difference between different sectors in terms of how much pricing power there is, and how much does this really rely on the overseas competition and what the prices are there?
Who does have pricing power right now?
I would say that certain luxury names have pricing power.
Okay.
I would say that there are, refrigerator makers. No, I'm kidding. I think that, there are certain areas that have pricing power. Think of Apple. How many discounted iPhones do you see? Not very many.
I know. I'm still struggling with mine. Still struggling.
You haven't gotten a new one yet?
I'm holding on.
Good luck with that.
I sort of tap into the website to think about doing something about it, but no, I refuse to do it. If you're deliberately slowing down my battery, it
feels pretty terrible when you go in, you drop a couple $1,000s, and you come out and they're cute little boxes.
Which iPhone are you buying? A couple of $1,000s?
No, I'm not saying for that. For all of the suite of products for the upgrades. No, come on.
John Lawler, CFO of Ford, coming up next from New York City this morning. Good morning.
From
from an EV perspective, we have confidence in the portfolio we have. We're a bit disappointed this year that we were constrained by the automation to build modules. We think we're going to see a strong adoption for our products. And as the charging infrastructure continues to be more robust, we think that's going to drive adoption as well as having affordable EVs.
That was Mary Barra there, the General Motors chair and CEO. In many ways, that conversation didn't really matter. What did was just a number. $10 billion buyback. Biggest buyback ever at GM. And you have to consider that before that was announced, the market cap was $40 billion. $10 billion, maybe to Apple or something. You know, drop in the ocean, nothing. Right. To GM, that's huge. That's a monster buyback after agreeing to a huge Labour contract only a few weeks previously.
There are a couple of questions embedded in why now, and I think you got to them with Mary Barra in your conversation yesterday. One of them is, does this suggest there isn't a better place to invest right now, that returning capital to shareholders rather than focusing on growing sales and growing revenues in other areas might be a more attractive proposition? The second thing is, going forward, how difficult is it going to be to have pricing power given the competition that you're seeing overseas?
Well, going forward, we've got some new outlooks. The latest from Ford this morning, a new range for 2023 adjusted earnings before interest, $10 billion to $10.5 billion. The previous range before suspending guidance, 11 to 12. We've got a lot to talk about. We can do that now with John Lawler, Ford CFO. Good morning, John.
Good morning.
Let's talk about it. Where is it? Where's my $10 billion buyback? Why a different approach from you and the team?
Well, we have a great plan in our Ford Plus plan, and we're focused on investing in growth and profitability, and through that, rewarding our shareholders with a higher price, plus also paying out 40 to 50% of our free cash flow in dividends. And so we're investing in the business. We have three great segments that are growth segments. Ford Pro, our commercial business, margins in the mid-teens for us. That's very high in our industry. Profits are going to almost double this year, more than double this year, and we have a great opportunity with the moats we have to drive significant profitability.
Costs are going up as well. So let's talk about the Labour contract. $900 to the cost of each car off the back of that UAW contract. Now, just for our audience, because you're aware of these figures already, GM, who we spoke to yesterday, are at $575. I'm still trying to sit here and work out, how do we get from $575 at GM and $900 to the cost of each car at Ford? What is that about?
Well, when you look at it, we're $500 to start in 2024, and that grows over time as wages increase. The biggest increase in this contract is gross wage increase. It's significant, over 25%. And then our footprint in the U.S. is bigger than General Motors, but the rest of that, I'm not exactly sure why their number is that much lower than ours. That's something that we'd have to unpack with them. We know what we've done with this contract. We know what the start point is. It's 60 to 70 basis points on our income statement basis. And now what we need to do is we need to work on driving productivity and efficiencies and reducing the labor hours, the hours it takes to build a vehicle, and reducing that cost. And that's what we're going to be focused on going forward.
So it's going to be cost reductions rather than trying to raise prices for the end consumer. Is that right?
Well, now, you have to think about pricing differently in our industry because all segments aren't the same. There's different pricing power across the segments. That's why we feel that what we did in segmenting the business and having the transparency around that is important. If you look at the commercial business in Pro, we believe there's still pent-up demand and pricing power there. However, in Blue, in the more of the retail consumer segment, you're going to see prices come down. We've been consistent talking about that. Back in 13.4% of disposable income to buy a vehicle. Went up to 15.7 in 2022. It's down to 14.5% roughly now. We see that coming back to 13.4% as you move through 2024.
When you talk about lower price points, I think about some of the Chinese car manufacturers and the production much more cheaply of electric vehicles in particular that are really making a competitive advantage. How do you compete with them, especially given the labor contracts and some of the other working operating costs that you're dealing with?
Yeah, it's a good point. And that's something that we're very focused on. Again, the segmentation, each segment is different. We've seen prices come down in the electric segment much quicker than we expected. And the reason for that is that we're moving out of the early adopters who are willing to pay for higher prices. Early majority customers aren't. They're not willing to pay that premium. So we're seeing those come down, and we expect them to equalize with gas prices. So it's all going to be about cost and efficiency, capital efficiency, et cetera. We have to get more competitive on cost, and that's what we're focused on in our second generation and third generation vehicles.
What is happening with demand in the EVs? What is happening? Is this real pushback that changes your approach?
I think what it is it's the adoption rate. It's flatter than what we had expected. The increase isn't as great. 50% up this year from a sales standpoint. So they're coming. It's going to be part of the industry. Eventually, we'll get to those higher growth rates. So we have to adjust our capital investment. We have to adjust our approach in the near term.
That sounds like a change in execution, not strategy.
Absolutely. It is a change in execution, not strategy.
So let's talk about the numbers. You've pushed out $12 billion in EV-related investments. Should we expect to see a little bit more of that going on?
Depends on the customer and the adoption rate and how that pushes out. If the adoption rate starts to grow faster, we'll increase our capital investments.
Well, let's go through the guide. I've got 2 points.
Sure.
I want to see if these are still up to date. So you did expect half the sales to be electric vehicles by 2030. Still the case?
No, we think it's going to be less than that, given where the
How much
consumer
less
adoption
will it be, John?
We haven't put a number on that yet. We're still looking at what that rate will be. I think we'll know more as we go through next year.
Is it the same for margins on those EVs as well? Do you have to reassess how big those margins will be?
Yeah, I think as the industry adjusts, you have to look at that. But we've set up our business structure, and we think the right target is around the 8% or high single digits.
You said that you're very focused on trying to be competitive in the EV space on price. Is that, and we asked about margin compression, you're basically saying we're going to see as we go on what the competitive landscape looks like. But how do you plan to reduce costs? Is it going to be with job cuts? Is it going to be with more automation?
So yes, absolutely automation. That is going to be a key part of what we do. Now, when you look at this contract, it's also important to understand for us where the battery plants are. And the battery plants aren't part of the contract. And so that's important for vertical integration. And when you're talking about electric vehicles, battery and design is really important. And the efficiency of that battery and getting the smallest battery possible in. So that second generation design is going to be critical from a cost standpoint. And then overall for us as a company, we have work to do on our cost and quality. And we're focused on that. We've made significant progress over the last few years. We restructured international operations. We moved out of autonomous vehicles and pulled capital investment out of that, focused on L2. We have the best driving system out there in Blue Cruise, according to Consumer Reports. So we're making the adjustments as we go.
When you talk about automation, and you know, there's a question around job cuts and how much this will reduce the overall number of workers who will have to be employed to make cars. Is that what you foresee, that there is going to be a fewer team of professionals that are creating vehicles in, say, 5 years than today at the Ford plants?
So in certain areas there may be, in other areas we see growth. The key is driving efficiency and productivity. So more coming out per unit of labor. It doesn't necessarily mean you take the labor out, you get more productivity. That's what we need to drive towards.
Let's finish on a delicate question. I ask this question a lot, and I'd like to ask it directly of you. Is a Ford F-150 Lightning truck, which weighs about 6,000 pounds, really good for the environment? Because I struggle with the association between these heavy electrified trucks and climate change. What is the relationship? Are we kind of kidding ourselves here?
I don't think so. I think that there's two things about the electric truck. One, it's moving into electric is important for the overall environment. That's true. But number two, you also have to think about the consumer and what that truck can do. It fills a niche that hadn't been out there. There are certain individuals that just will not drive an internal combustion vehicle. They never had access to a vehicle in the utility like a pickup truck. They now have that. Plus, for our commercial customers, it's a tool. It's a generator. They use it on the job site to power. Now you don't have gas generators sitting out there. It's electric. It's coming from the vehicle itself. So it is a good step forward in the environmental push and in reducing the CO2 footprint.
That conversation will continue. It's good to hear from you. Great to get an update on the numbers as well. Thank you, John. Appreciate it. John Lawler there, the Ford CFO. I have to say, Lisa, and some things that John can't really say, given that he's over at Ford, but confusing to hear that from Ford and then think back to what we heard from GM yesterday. Are we seeing more transparency around costs from one company maybe than from the other?
Well, we will explore that going forward. There's going to be a real question here. Yes, because this is going to be key to margins, key to pricing power, key to figuring out the competitive landscape. It is a big concern. In other words, how much of a hit does that mean to each particular
It's pretty curious. Ford are out there saying,
it
like, the number's right up here, and GM's saying, yeah, it's down here. Okay. Kelsey Barrow's coming up shortly. JP Morgan Asset Management. John, thank you. It's good to see you. Appreciate it. Futures on the S&P 500 positive by 0.25%. Yields up by 4 basis points, 430. The surprise of the month, though, yields down aggressively through November. More on the month that was and the month to come, coming up next. We are closing out, wrapping up the best month of the year on the equity market, on the S&P 500, pushing 8.5% up. Month to date, massive. On the Nasdaq 100, best month going back to July 2022. First month of gains, incidentally, since July 2023. Equities up this morning by 1/3% on the Nasdaq, up on the S&P 500 by 1/4%. The Russell up by 0.1%. The regional bank stocks absolutely flying this month as well. You can say thank you to the bond market. 2-year, 10-year, 30-year shaping up as follows. The 2 years come down from north of 5% to 465. The 10 years come down from north of 5%, Lisa, to a break of 430. Even with a 4 basis point move this morning, higher, we're back to 429.55.
So now do we get confidence that we're seeing stability or just another whipsaw move that sets up the next leg of a narrative, right? I mean, this is sort of the key question here. How much can we get confidence that, yes, we've seen the peak in benchmark rates, but that is going to lead to an ongoing disinflation back to 2%? That is a straight line that will lead to a very low 10-year benchmark yield as well.
You don't sound exhausted by this at all.
Well, it's like, come on. I mean, it's just frustrating because it feels like we're trying to justify something in a different way depending on where it is at a certain time. Hard to understand whether this is positioning, whether this is I don't really get what is actually driving the volatility. And so it's frustrating a little bit to try to explain it.
We should clip the comments from October 19th. Everyone justifying why yields are above 5% and play them out now and ask them what's changed in a month. What's changed in a month apart from the price action?
I think that the one thing that has changed is that you have seen disinflation, true disinflation, and the data's come in less than expected, and you've seen it not just in the U.S., but also globally. You've seen it in Europe, and we saw that again this morning. That does shift the narrative. Now the question is how much weakness comes with it, right? And we did see greater weakness than expected in Europe. Do we continue to see that in the U.S.? And how long is this tenuous Goldilocks, this sort of soft landing narrative, how long is that really in play?
You talked about Europe, big downside surprise on CPI this morning. Let's talk about what it means for the euro. The euro has been stronger this month, much stronger this month against the weaker US dollar. In fact, before today, heading towards the best month for the euro and worse for the dollar for the year so far. We're back to about 109.21. Got some euro weakness out there this morning. That data just introducing the conversation we're having on this side of the Atlantic, on that side of the Atlantic, which is rate cut chat to go into 2024.
So are they going to have, and you put this really well, is there going to be a conditioning of getting it so wrong with inflation on the way up that they're going to be late to the game to cut? And we heard a bit of pushback to that earlier. But now there's a question, Janet Henry saying that that's not necessarily the case because it's not a policy error to over-tighten because they're at least going to get inflation under control. But there's a question here around whether the weakness in the economy is going to force their hand more aggressively at the beginning of next year.
I just think we're talking about human beings and not machines. And human beings are conditioned by their experience, and they were conditioned by what happened 2 years ago in a massive way. I think almost embarrassed by it. Let's face it, almost embarrassed by it. You're on the FOMC, you went around for months saying one thing and something else happened. They're going to be very nervous about making the next move.
The key litmus test to me is whether they use the word transitory ever again. If they use the word transitory, they're not embarrassed and they're not conditioned.
I agree with that. That's a good test.
I think that's a good test.
They haven't been humbled at all.
No.
If they start saying, we were right, it just took longer.
But I mean, that kind of is what some people are saying, though. So just throwing that out there.
We were right. It just took longer. Yeah. OK. Let's get you the latest stories this morning. Under surveillance this morning, Henry Kissinger, the former Secretary of State who defined American foreign policy during the 1970s, has died. Kissinger is best known for his strategies to end the Vietnam War, open US relations with China, and bring about the détente with the Soviet Union. He was 100 years old. He was also, Lisa, a highly controversial figure.
Especially because he was someone who thought that idealism was out of place in foreign policy. And he was behind a lot of policies that were very protested and very controversial. Interesting to see how some of his philosophies have made their way through the decades and still exist today.
Let's turn to our next story. Israel and Hamas extending their truce for another day, just minutes before it was set to expire. Hamas releasing 10 more hostages and Israel releasing 30 Palestinian prisoners. Secretary of State Antony Blinken in Israel for another round of shuttle diplomacy. Blinken is expected to make stops in the West Bank and the UAE to round out the week. The pressure for that truce to continue, Lisa, every single day builds.
Especially given the fact that Israel continues to reiterate the fact that it wants to eradicate Hamas. from Gaza and from the Palestinian people, and you still have the discussion of the Hamas having in its charter that it would like to eradicate Israel and the existence of a Jewish state. So nothing has fundamentally changed. That said, the pressure to bring home hostages is very great, and the pressure to get humanitarian aid into Gaza so that people have enough to eat and so that they have fuel to power their stoves is also very great. So that is bringing them to the table, although it's getting a lot more difficult. It was a last-minute decision to get this ceasefire to continue for another day.
It was fragile, but you'd have to say encouraged just a couple of days ago when we had accusations on either side that framework for a temporary truce had been violated, and yet that truce held. I'm not sure how encouraged we should be by that, but encouraged nevertheless.
Exactly, but it does highlight the fact that it's getting longer and longer to come to some sort of agreement and the parameters of it, and there are different rumors coming out. It gives you a sense we might be reaching something of the end of this.
Economic data about an hour away, so let's go through some of it for you. Bloomberg Economics expecting a downturn in personal income and spending. The core PCE deflator, the Fed's preferred inflation gauge, also expected to ease with volatility in today's jobless claims, thanks to the Thanksgiving holiday. Fed President Barkin offering opposing views on the path forward. Bostic saying disinflation is likely to continue. Barkin leaving the door open to further rate hikes. The weight on the former and not the latter in the bond market yesterday.
Yes, although honestly it didn't really move the needle either way because it's basically what they both have been saying for a long time.
For months, hasn't changed. For months,
right. So I think that's the reason why Chris Waller had more sort of an impact on markets. That said, to your point, nobody was listening to anything other than something that would lean into ongoing disinflation and lower rates ahead.
A selective validation, I think, of pre-existing biases, which seems to always be the way in financial markets. You cherry pick what backs up your thoughts already. Kelsey Perot joins us now, fixed income portfolio manager at JP Morgan Asset Management. Kelsey, good morning to you.
Good morning.
The world's moving towards you. Lower bond yields, maybe a slow economy in our future. How are you thinking about fixed income now?
So you're right. Yields have moved lower. What we've had is the situation where the narrative can take you much further than what's actually happening in terms of reality. And so we looked at the move higher in yields in September and October, getting to 5% on the 10-year. And we did think that was just a bit too far in terms of a move, and that we would look back and view this as honestly a great buying opportunity. We've had a positive view on fixed income this year. Yields have moved back down, and that's essentially brought us back to where we were before the September FOMC meeting. So what I'm really focused on right now continues to be the inflation data. So the inflation data, what do we benchmark ourselves against? It's coming down. It's still above the Fed's target. So you have people on both sides saying we haven't done enough, but maybe we have. I look at what they projected in September, and September was a fairly hawkish meeting for them. They were projecting inflation of 3.7% on core PCE. Today's number, if it comes in on consensus at 8:30, will be down to 3.5% on the year-over-year rate, and will be down to 2.6% on the 6-month run rate. So bottom line, inflation is coming down faster than they expected. We think that the Fed's last rate hike was July. We've had that call for quite a while now. We're sticking to that call. And that makes the moves for yields asymmetric. We can move a little bit higher here for sure. I mean, there's a lot of volatility on every given day. But on the other hand, we can move a lot lower if next year we're looking at rate cuts.
You said the narrative can take you much further than the reality. Does that mean that we're in a trader's market?
So I do think that the technicals and the positioning are very important. You need to understand not just what's going on, but what is the sentiment around what's going on. And you had a couple things that were really fueling that bearish sentiment in October. One of them was the fact that you had a blockbuster GDP report and there was uncertainty about what was going to come next, right? We've now at least gotten to the point where we feel comfortable that we're not going to see another 5.2% on real GDP and 9% on nominal GDP. Atlanta Fed tracking has come out. We're normalizing back to around 2%. So we can feel comfortable with that. I think the other thing that you're not hearing any words about anymore is the deficit. Right? The auctions. Lisa, I know you love watching the auctions. They've been mixed, right? You've had some weak ones. You've had some poor ones. In fact, you had that 5 basis point tail on the 30-year auction on November 9th. That ended up being a great entry point into the bond market. And so, sometimes the market fixates on something. Ultimately, we think it's going to be about the fundamentals. Again, what's our view on inflation? What's our view on the Fed? Ultimately, it's not about if people will buy treasuries, it's at what price do they think it's fair. And if inflation's coming down and the Fed is done,
can I jump in?
The price is fair.
Why isn't the deficit part of the fundamentals?
I mean, I think it is part of the fundamentals in terms of the growth and inflation outlook. But here's the thing. The deficit was wider than expected this year, but inflation came down. When you're a country that can print their own currency and they have their own reserve currency, it's not really about default risk. We're not worried about the Treasury defaulting, right? The risk is inflation if you print too much money. We are not seeing inflation. That's because the increase in the deficit this year was because of two factors. One, higher interest costs, but more importantly, lower tax revenue. We're not talking about fiscal stimulus here. We're talking about an economy that was normalizing, revenues that were falling, and then a government that has to fund more because the Fed's stepping out of the way.
It strikes me that you said that the moves now are asymmetric when it comes to the bond market. It makes sense to me on the short end, because if the Fed is done raising rates, sure, I can imagine that that's the case. For the long end, though, there just are so many variables, as John was mentioning earlier, whether it's the deficit or whether it's the fact that the Fed cutting rates sooner leads to perhaps higher inflation over the longer period of time. How much less conviction do you have over your longer-term bond yield call on the 10-year?
So there's multiple parts to that question. One, the first thing that comes to mind is that we are moving into a regime where we should be seeing the curve steepen. So the part of the curve that we should see the most rally, the most move lower if the Fed is cutting rates is going to be that front end. So I would agree the asymmetry around yields is more compelling in the front end than that is in the long end. And I do think that structurally longer term, we are exiting a period of financial repression. And so we are probably at a point, and this is a good thing for bond investors. You know, we're not dealing with negative real yields anymore. We're not dealing with 30% of the global bond index having negative yields. This is ultimately a good thing. Higher real yields, but it does mean that we're not necessarily looking at 50 basis points on the 10-year next time we're in a recession, which is what we saw during COVID.
It's what Lisa complained about for 10 years in every single column.
Yes.
The world of negative rates.
It's true. 100%. I stand by it.
I think everyone does. It was ridiculous. And I hope we don't get that. Honestly, what was absurd about that period is we all knew it was absurd. It was like one of those bubbles that people would come on and sort of like rationalize and justify. It's one of those things where we all knew it was absurd, but it was pinned there, placed there by policy. Policy was deliberately anchoring it. And that was what was totally absurd and original about that moment.
The biggest surprise for me is that we heard all these people saying the world was going to fall when you didn't have zero rates. And the fact that it hasn't continues to be one of the biggest surprises that we haven't seen, the complete demolition of balance sheets that were really grown up, that were really raised in zero rate policies.
How many people came on this show and said the long and variable lags would be 30 years long? Hardly anyone did. No one did.
No one did.
And now it's like, yeah, they're longer, much longer. Cassie, good to see you. Cassie Barrow of JP Morgan Asset Management. If you are just joining us, welcome to the program. The scores look like this on the S&P. We are positive by 0.3%. Yields are a little bit higher by 4 basis points, 4.2916 on a 10-year, which is quite a turnaround, Lisa, from the start of the month.
And it really raises this question to Kelsey's good point, which is how much is the trading moving so much faster than anything fundamental? The narrative is shifting so quickly and people are getting on board. Again, the technicals underpinning this. It raises this question, especially if you've got the likes of Bill Ackman coming out and making these bold rate calls. I mean, what is the hedge fund activity or the levered bets that are behind some of these moves?
It's the psychology of investing. It's always the same. It never changes. You get to 5% and people are like, sell. You go back to 4.30 and they're like, oh, quickly, buy. Yeah. It's the same in the equity market.
Yeah, although you do wonder if things are moving faster than they have before, just in terms of the narrative shifts. What is the saying or something that the markets are the only place where you buy something when it's full price and you sell it when it's on sale?
Oh, yeah, totally. I totally agree with that statement.
It's right
like anything else, right? It's like the sales are on, let's go.
Yeah.
And now in markets, it's like, no.
What do they know?
Oh, my, no. Coming up next hour, Neil Dutz of Renaissance Macro, why he thinks it's soft landing nirvana for this equity market, that conversation. Just 60 minutes away.
how to strike that balance between ultimate values and what reality imposes on you. And reality is never quite adequate, but ultimate values are too absolute because they demand a degree of imposition on others. How to strike that balance is maybe given to us as our insoluble problem.
That was former Secretary Henry Kissinger speaking to Bloomberg editor-in-chief John Micklethwait earlier this year. Kissinger, the former US Secretary of State who defined American policy in the 1970s, has died aged 100. I'm pleased to say that joining us now is John Micklethwait, the Bloomberg editor-in-chief, joining us from London. John, good morning to you, sir, and great to catch up as always. Let's talk about the legacy of a polarising figure, a man who you knew for the best part of 3-4 decades. What is your takeaway on that?
I think he was a giant. I mean, obviously not a giant physically, he was quite a small man, but he was a giant in the sense that it's very difficult to think of anybody else. I was just thinking as I walked through the streets of London this morning, the possible exception of the Queen, I don't think there's anyone who had been part of public life for as long as Henry Kissinger, had met as many people and had, in his case, obviously more controversially the Queen, but had such a dramatic effect on it. I think he was someone very obviously in terms of legacy who changed the world through the bringing China back into some kind of unity with the West and bringing China in from the cold. I think that was a huge deal. You look at détente, all the different things like that. And yes, there were very public and very obvious costs to that, but he was a man of many, many parts. And I think it wasn't just the things he did, it was the breadth of his interest. At the end, he was consumed by AI, but this was a man who was quite a formidable student of history, and that's how he first emerged. And he had a personal life story, which I think kind of captured the century, beginning as someone persecuted, driven out of Germany, arriving in America, coming to serve in the Battle of the Bulge as a still incredibly young man. He saw things by the age of 24, 25 that very few people have seen who are currently leaders of the world.
John, in the 4 decades that you knew him, how did his worldview evolve, especially with some of the shifts that were going on globally?
I think he did change his views, but his basic attitude, and that somewhat convoluted quote that you began with, I think is very true of the way that he saw the world, that there were a set of values, but then there was also reality, and the two conflicted continually. And so I think particularly when he was in office, there was a lot of trying to compromise in terms of what he was trying to achieve with the realities there, and sometimes those were spectacularly bloody. That's why people will bring up things like Chile and Cambodia and places like that. But his underlying sense about the direction in which he wanted to go, I think, never really changed. And he continually also, I mean, in some ways, it's psychologically interesting, his desire to be relevant, his desire to still be part of the debate. A man who's age 90-something discovers AI, but thinks that that is something you should look at through the lens of Metternich, through the lens of balance of power, and what that can do to the human condition and what that could do in terms of war. Most obviously, the idea of computers fighting each other terrified him, but also that basic idea about what it meant to be human if you had machines that began to think of human. That went right the way back to the political philosophy that initially grabbed him. So yes, I think the reason why he's interesting is partly the life story, both in the sense of a child whose odds of survival were extremely small, ending up as one of the most powerful people in the world, and that desperate and rather ingenious ability to stay relevant long after he stopped being Secretary of State, long after he stopped being National Security Advisor. But also this sense of having something sort of bigger about the world. Kissinger was never someone who ran away from large issues to do with philosophy, large issues to do with science. Any of those things he sort of sucked in. So he was a complex, sometimes a very intriguing man. But he was, to that extent, I think he was one of the most influential people of them. the time I've been a journalist.
We've mentioned how polarizing he was in several occasions, and you talk about how he was guided by right and wrong and less concerned with the method of getting there. Come under a lot of criticism from the bombing campaigns, as you mentioned, in Vietnam, in Cambodia, with Pinochet in Chile, also with respect to how he really directed policy toward Russia. How much of his philosophy is consistent and strains today of U.S. foreign policy?
I think that an interesting question is that if you look at American foreign policy over the past 30, 40 years, and there were, different times it was run by people who were extreme critics of Kissinger. The neoconservatives hated the idea of realpolitik. Bill Clinton liked the idea of a more kind of worthy foreign policy, so did Barack Obama. You have to ask yourself the question, would America be stronger if Kissinger had run it? I suspect it might have been. Would the world be more peaceful? I think possibly it might have been as well. I think he always took the long view. And you look at the issue of America and China, the one which sort of dominated a lot of the questions of the past 10 years. What Kissinger repeatedly did was he went back to the issue about great nations have kind of interests, and you have to find ways to accommodate that. So yes, by all means, bring up the issues that divide you, but then try and work out what is possible within the parameters of the interests of those nations. And the reason why he had that, I think, was partly to do with history, the people he studied, people like Metternich, Talleyrand, those were his heroes. They dealt with similarly bloody wars and the aftermath of it. And there was also, I think, a little bit of personal history in that. If you come from the background he did, of one being persecuted, being on the run, narrowly escaping first to London and then to New York, and seeing unimaginable terror, I think in a strange way you are always looking for some kind of attempt to reconcile these things, to try and bring a little bit of order to the chaos. Obviously at different times he got that wrong, but I think that was the underlying philosophy he lived by.
John, you touched on this. There was something deeply unique about how we, the media, treated him, and other countries as well. China would entertain a visit only recently in ways that they wouldn't even entertain for some officials from this White House, from this administration. John, what do you think that was about? That was deeply unique from my perspective, looking at that situation. I can't think of anyone else quite like that. What was behind it?
No, I think it was two different reasons. Number one was the things that Henry Kissinger knew. In the fact that in China there is a veneration for old age, which isn't always true of the media, for instance. But in his particular case, there was that. So he had history. You know, he had sat there opposite Mao. He'd sat there opposite Deng. He knew the people who the Chinese talked about, and so there was something big about him that they understood, and they saw him as someone who understood their problems, even if and who would criticize them in private. On the other hand, I think being honest, I think another big problem, another reason why he stood out was because there really weren't very many other people like him. If you go to Beijing, you meet an enormous number of people who follow the intricacies of American politics in great detail. The number of Americans who really know and understand China is much, much smaller. And so I think he was both in that role because of his own qualities, but also, you might say, because of the lack of qualities of other people.
Hey, John, appreciate your time this morning. Really do. John Micklethwaite there of Bloomberg, our editor-in-chief, on the legacy of a deeply polarizing figure, Lisa.
Yeah, and just how his diplomatic efforts and role continued far after he left office into a very different era.
More coverage still to come on Bloomberg TV and on Bloomberg Radio, included on this market. Turning to the economy in about 35 minutes' time, you will get some jobs data, jobless claims, kind of the appetizer before the payrolls report next Friday. Claims recently were ticking higher, then all of a sudden, right before Thanksgiving, 209. Anyone who looks at a long-term chart of jobless claims, 209, exceptionally low on a historical basis. And Lisa, once again, speaking to a consumer that's holding on.
It's confusing to me. There are a couple of different markets that I don't really have a full clarity on. One is the housing market and one is the labor market, because we've been hearing about job hoarding. We've been hearing about how this is going to be a job-full recession, that people are going to stay employed, but maybe it'll be harder to get hired, which is kind of the suggestion that we got from the Beige Book. Unclear. history does have some merit as well here.
Steve Whiting of Citi Global Wealth is going to join us around the table on financial markets. Also need to catch up with AMH, Anne-Marie down in Washington, D.C. on the latest in Washington, and also an OPEC Plus meeting which was set to be in person last week, now virtual, with the Saudis pushing for, guess what? Production cuts, because crude right now is in the 70s. Live from New York City this morning. Good morning.
Bond volatility is still higher than equity volatility. I think equity volatility is priced for soft landing.
The market is volatile right now because nobody really knows what to do or what to expect.
We still do favor the growth side of the equation. We still think that there is value in growth.
Right now, the long-term view is still cautious.
I think we'll be at new record highs for the S&P 500 early next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Closing out the month of November, wrapping things up with some choice quotes from some great guests. I'm thinking of the likes of Jack Caffrey at JP Morgan. What a year November's been. I'm thinking of Neil Dutt of Renmac, who's going to join us this hour. Neil saying it was soft landing nirvana for the equity market, and wow, wasn't it? This equity market month to date on the S&P 500 up 8.5%, and we've got double-digit gains on the Nasdaq 100 for the month of November.
It has felt like a year because the narrative shift brings us right back to where we were not so long ago, and it feels like a year of narratives that were just packed into 1 month. How much do we see this sticking versus just the latest phase in table tennis, or ping pong, as Jordan Rochester called it? This really is going to be the key question heading into December.
You want to talk about the bond market move?
It
Down
was
something like 60 basis points month to date, encouraged this week by some choice comments, some selective hearing, maybe, from Governor Waller, who was basically saying something's giving and maybe it's this US economy. There's one final chance to push back going into the quiet period. That is in the hands of Chairman Powell. Citi this morning saying Powell has the opportunity to push back against the cuts priced in when he speaks tomorrow on Friday. They call it a significant risk, but there's a big but here. If his colleagues are any guide, Powell's pushback will be limited and risk-on conditions will continue.
And that seems to be kind of the feeling that it's unlikely that he's going to come out and put the kibosh on a market rally, because he hasn't seemed to show any willingness to do that at the previous meeting, even though he had an opportunity to do so. People said that maybe he was coming out overly cautious and dovish. That said, the data has surprised the downside when it comes to inflation. It's why core PCE, the deflator indicator that we get in about a half an hour time, is going to be so important. Do we have the ongoing disinflation that's going to give them comfort that actually we are getting back to price stability?
Should we talk about Ford? I think we should talk about Ford.
Okay.
Ford in the pre-market looks like this. Ford this morning reinstating guidance, 10 billion to 10.5. That was lower than the previous guidance, which was suspended during the UAW negotiations. That was 11 to 12. But there are some massive differences out there between them and GM. GM notably coming out with a $10 billion buyback program yesterday. We did not get that from Ford this morning. Ford saying the costs from the UAW contract are going to come to about $900 to each car, shaving margins by 70 basis points. That is several $100s more than what GM was telling us yesterday. Makes sense of that?
Well, they're saying it's for next year when a greater proportion of the contract goes into effect. I can't make sense of it. There is a component, as we were hearing from John Lawler, that there is a greater domestic U.S. focus of production of Ford. So maybe that's offset there, but it's unclear. And so it raises this question, first of all, how much is this a consistent cost? Second of all, how much clarity are we seeing in terms of what the costs are going to be and where they're going to be accepted? And third of all, just how much are we going to see this in margin compression? How much are we going to see this in higher prices? And what does this do to the competitiveness of U.S. auto manufacturers?
There was a key line from John Lawler, the CFO of Ford, in our conversation a little bit earlier. And I think it's a key line as we start to think about the jobs report next week. Here it is. We need to work on driving productivity and efficiencies and reducing the labour hours. Goes on to say the hours it takes to build a vehicle and reducing that cost. That, for many economists, when you get a labour market report, first thing to look for. Reduced hours, particularly when we're talking about holding on to labour because of the experience of the last 3 years. We couldn't hire quickly enough, so you're certainly not going to start firing. But if you want to make a move, if you want to pull back just a touch, productivity, of course, is one, but ultimately pulling back on hours worked, that's where you're going to see it first.
And that seems to be what's happening. If you take a look at the data, hours worked have been coming in slightly. But to your point, is this a template for what we're going to see elsewhere? That basically the way that you're going to offset extra costs is simply by increasing productivity, by reducing the amount people work and paying them de facto less, even if hourly they're being paid more.
TK said it yesterday, bombshell over at GM. I don't think just for the auto sector, I think a lot of people have got to look at that and think, oh, what's my move? What's my move into 2024? This is my move right now, this morning, and good morning to you. Here are the scores. Your equity market looks like this. Positive a third of 1% on the S&P on the session, on the month up big time. We've talked about that all morning. On the session, yields are higher. On the month, aggressively lower. Your 10-year yield at the moment, 4.2859. We've got some Fed speak for the next 24 hours. Some data 25 minutes away. Elisa, jobless claims just around a corner.
Yeah, are you focused more on jobless claims or core PCE?
I'm going to go with claims,
really?
To be honest with you.
That's interesting.
Yeah, just to see them hanging in there at 200k. Personally, I say that just because I was so surprised last week. The question I'd been asking for the best part of a month off the back of some of Data's research, which I know you're going to ask him about a little bit later. Neil essentially was saying for the Fed, the labour market is no longer a reason to be hawkish. So I think the equity market started to pivot to, okay, this is what I need to think about now. At what point is that labour market going to be a reason to be bearish? Watch claims. Claims had been pushing higher, and now they're back down to 209. Is that just a blip into Thanksgiving? Is this kind of data distorted somewhat? I don't know. But just to have claims still down 200k, near 200k, unemployment sat at 4%, deep into this hiking cycle is kind of surprising.
And it's a good point because when we talk about the disinflation, that's year-over-year comparisons, and Janet Henry of HSBC was just saying that come next year, those comparisons are going to get more difficult to beat. And so you might see a re-acceleration of inflation. It really depends ultimately on labor market.
Absolutely. Joining us now on that, Steve Whiting, Citi Global Wealth Chief Investment Strategist and Chief Economist. Steve, good morning to you. It's always great to catch up, buddy. Let's just start with the Fed speak so far this week. Any reason to believe the message that we get from the New York Fed President John Williams, from the Chairman Jay Powell, is any different to what we've heard already?
Look, I don't think they can micromanage markets overshooting in both directions around their comments. It's actually good now to start getting the preconditions for the end of the tightening cycle, what it would take to ease these expectations, understanding that the Fed at some point is going to have to be forward-looking. It's not going to ease monetary policy when the economy has collapsed, right? If their monetary policy is restrictive, if inflation is falling to target, and I can definitely make the case for that, and employment decelerates, they're going to want to be careful about having restrictive monetary policy. Now, whether that takes 3 quarters or 2 quarters of time, that's the kind of thing that the economy will determine, right? But really getting this out and clear into the marketplace that their job is also not to force down the economy under every circumstances. That might be a little bit helpful, and I think the market has run off with that.
Given that, Stephen, are you leaning into what we've seen with respect to the bond rally? Do you think that the move that we've seen in November has legs, or was just another year packed into a month?
Look, I think it's a little too fast, but it's not too far. You consider where we think bond yields will be at the end of next year. We think 10-year yields will be 375. We think that the labor market is going to slow significantly. Fortunately enough, and this is the strange thing that's giving us a sense of bullish view of where we should be going without a contraction rebound cycle, is that a lot of industries have really contracted already. And if we were to take a look at their headcount, we're surprised it's not lower. Now, there have been other areas that have been asynchronous and employment is still growing. But we think that a lot of cyclical industries are going to find their bottom in the coming year and recover while the labor market is slowing, while measured inflation is coming down and bond yields are moderating. So that's a different financial environment from what we've been in the last 2 years. And again, you could run away with that and go too far very, very quickly. I don't think that we really overshot where yields will be or where the equity market will be if we look out a little further.
So then how have you readjusted, Steve? I mean, if essentially you don't think it's overshot, it has moved fast. Does that just mean that basically you're not going to do anything for the next 2 months and wait for things to sort of catch up and then you'll take some action?
Well, okay, we've already made a bunch of changes, going back, particularly in October. Small and mid-cap profitable growth companies have had no return this year. And yet they're outgrowing large caps. And in fact, the growth companies don't have the highly indebted situation that small cap banks would. So we've added an overweight there. We think that a broadening equity market is the way that we will see the markets in 2024. It's not that we're going to get another 18-19% gain in the S&P 500, but most stocks will be looking forward to a broader earnings recovery. So that's one way that we can play this. Another, again, is fixed income. Yields are down a little bit, but think about where cash will be in the next 3-4 years. The Fed's expectation for its long-term neutral policy, now whether it gets exactly to 2.5%, but that's where they are. So again, this rally in the bond market and thinking about some of the spread assets for high-quality bonds that are still north of 6%, this is, again, the way you can still have higher for longer in your portfolio.
Steve, let's get into next year just a little bit more. Base case for a lot of people, slower growth, lower rates, which kind of screams growth and tech. Then at the same time, to your point, we are expecting this broadening out of a profits recovery. How do those two things compete with each other when we start to think about leadership?
Right. Well, look, Magnificent Seven have had a fantastic growth year. I mean, one semiconductor company has massive growth. If you take a look at the next 9, they don't. So when you think about valuation, I'm really not taking an active bet against large cap tech to really underweight or overweight. But the opportunity, again, in a world where a lot of the bond market in the world is still an incredibly low yield, 200 basis points below the U.S. for other DM yields, is to take advantage of the catch-up, probably leaning a bit toward growth, but not in the largest firms, right? Think about all of the cybersecurity companies that are not trillion-dollar companies is one example of that. Think about some of the healthcare companies that look like they've had their first recession. And that is, I think, an opportunity for broadening in the equity market.
Steve, good to get your views. Steve Wine in there of Citi Global Wealth. Appreciate it. Looking ahead, Lisa, to next year.
Yeah, and this is going to be a key question going forward of how you navigate this. Again, I just think big tech is going to be everything. You're laughing at me. Why are you laughing at me?
I'm not laughing at you at all. Why would I laugh at you?
I don't know. I could just tell. No, but honestly, look, it is exhausting a bit that we're going into the same.
I just love catching Bramo sort of like transfixed by cat videos on her screen. How do you do that and provide world-class bond analysis is beyond me. I don't know.
I've got to say, my experience.
One part's to like calm down half the brain and then sort of like keep the other side engaged.
I mean, basically, yeah.
I love that. If you are just joining us, welcome. Your equity market positive here by 0.3%. Yields are higher by 3 basis points, 428.59. Lots to discuss. I just think Neil Dutter's been great over at Renaissance Macro. I know I say it all the time, but he has been. He's going to join us in about 18 minutes' time. He was constructive on this economy when many other people weren't. He's looking at the data right now. And if you just listen to the guidance from Governor Waller, and I think this is probably what you're going to get into with Neil a little bit later, Governor Waller's basically saying if inflation continues to trend lower. And Neil's sitting there looking at the data, and many Fed economists are as well, suggesting, well, let's sort of probe that if. How much of a if is it? How big is that if based on what's already in the pipeline? And for many people, it's not a big if.
Well, and this is the reason why a lot of people are talking about rate cuts even without some sort of recession. What I want to hear from Neil Dutta is how do you pair the idea of a nearly 9% annualized GDP in the United States on a nominal level for 2024, if you just 2023, if you extrapolate out the third quarter, how do you take a look at that and think that this is going to be successful, that disinflation will continue, that you'll be able to have enough weakness to cause the nirvana of soft landing to continue?
I think it's the fact that we've had 9% nominal GDP in the third quarter, that we've got unemployment south of 4%, that claims are at 209, and yet we've still experienced this disinflation. I don't think anyone wants to extrapolate out Q3 to anywhere based on the growth we just saw. But even if you keep it at 2, you get a slowdown. That's what surprised me, that we've had this disinflation even with everything we're talking about in the labour market and beyond.
Which is the reason why I wonder, how much is this gas prices? How much is this durable goods? How much is this just a shift versus services and goods that continues? And how much is this just year-over-year comparisons that are just difficult to beat once again? I mean, again, can we really shift the whole narrative once more?
If you want. And also, I've thrown a new one, another one. How much of this isn't the Federal Reserve?
That's a good question.
That's a big one too. AMH up next from Washington, from New York. This is Bloomberg.
From day one, we have been focused relentlessly on trying to secure the release of hostages. from Gaza and from Hamas. This process is producing results. It's important, and we hope that it can continue. At the same time, I look forward to detailed conversations with the government of Israel about the way ahead in Gaza.
That was the US Secretary of State Antony Blinken sitting down with the President of Israel in Tel Aviv early this morning as Israel and Hamas agreed to extend their truce by just one more day. With us down in Washington, D.C., we can say welcome back to Bloomberg's Anne-Marie. AMH, let's get straight to it. An extra day. Why a day-by-day approach to this truce now? What's changed?
Well, the Israelis are really doing this day-by-day approach, and this one came down to the wire, Jonathan, about this extension. It does seem, when you look at what Israeli officials are saying, what the Israeli military is saying, is that this is only a tactical pause, and they want to make sure that they are going to eradicate Hamas. When you look at some of the statements, whether it's President Herzog or Prime Minister Netanyahu or the head of the Israeli Defense Forces. So it does seem that is why they're doing this day-by-day approach, also making sure they get these hostages out, which is why this trip Secretary of State Antony Blinken is making, his third since this war began, to the region is so important at this moment, because it's clear from what the U.S. is saying, behind the scenes and also in the open, that they would like to see a prolonged pause to make sure they can get all these hostages out. As on top of that, they want to see more humanitarian aid going into Gaza.
Anne-Marie, we've talked a lot about how there's been a lot of disagreement within Joe Biden's own party, with a number of lawmakers who are Democrats coming out and saying that they wanted conditions put around aid to Israel during this war. What's the latest on that? How much is the tide shifting in that direction versus sort of still supporting some sort of ongoing unconditional support of Israel?
Well, sometimes it's a hard line for this administration to walk. They had this bear hug mentality with Benjamin Netanyahu. The president went there, embraced him, said, we are standing shoulder to shoulder. They still maintain that, but at the same time, they are exerting a lot of pressure on Israel because the images coming out of Gaza are horrific of the humanitarian toll this is taking, the civilian death toll of Palestinians. And that is why there's a lot more criticism from the public and from within his own administration about this policy. So you do see some individuals calling out the fact that they want some conditions attached. It doesn't seem like the administration is supporting that just yet, but potentially that's what might be on some of this aid. If Congress is able to get this through, we could potentially see. But it is still a debate in Washington and is something that is looming large over this administration.
We'll get more on that throughout the days and I'm sure weeks ahead as this does evolve. I do want to just shift gears a little bit, Anne-Marie, and talk about the OPEC Plus meeting happening from COP28. The fact that it's virtual and that people are there talking about how they're going to reduce fossil fuel emissions while also negotiating how much oil they're going to pump. How much do you see this as really a result, the idea of making further cuts, as a result of U.S. production, not necessarily just diminishing demand from consumers?
I really see this as a price issue. The Saudis continue to talk about market stability. And when you see the fact that what has it been, 10, 13, almost 15% in the last 2 months that oil prices have dropped, that's a concern for these oil producing countries. Obviously, when you look at what the first quarter of next year looks like for the oil market, they are seeing a surplus. They want to flip that on its head. They want to see a deficit going into next year. So that's what this negotiation is about right now. I really think it comes down to market stability, or, the diplomatic way of saying it comes down to price, although OPEC energy minister will ever tell you that's what it's about. It is what it's about. They need to work out, though, whether or not they can get the likes of Angola and some other African countries to agree to lower quotas. And if not, potentially we'll just see a rollover what they have established last month.
It sounds like a defenseless CEO of a company, doesn't it, when they just start to say it's the short sellers, speculators, Wall Street.
Yeah, pretty
much. Not the fundamentals of the company at all. AMH, what do they mean when they start talking about that it's the market environment, whatever they've said recently? What does that mean?
It means that they want higher prices. They want to put a floor under this. They don't want to see the dwindling of oil prices around the world. And they want to make sure that they're putting the speculators in the market. I mean, Prince Abdulaziz bin Salman has never been shy about calling out the speculators and telling them to dare him or tempt him. So I think that's what this is about. But it comes at a time when, you know, I don't think there's a lot of friction right now. Well, you'll see friction if OPEC Plus does decide to take this next step in a million barrels cut with the administration, because gasoline prices are lower right now. They could potentially give this one to the Saudis. They are helping them in the region right now with this war. Things are stable at the moment, at least in terms of this has not become a wider conflict. So potentially they do give them this out and they shrug this off where gasoline prices are, but potentially this could look a little bit different as we go into November of next year.
You've covered this for years, and I know this is slightly unfair, but based on your coverage, what is the number they want? Right now, Brent crude's at 84. If they're not happy with that, what are they happy with?
I mean, I think the Saudis deep down would love $100 a barrel of oil, but maybe something closer to 90. Certainly put a floor at 80, 85, but I think something closer to $90 a barrel. I mean, the IMF for years has said that's where their budget would need to be in line with. But yeah, around 90 to 100, I would say, would be their sweet spot.
AMH, thank you. The latest down in Washington, D.C. Anne-Marie Hordern there. On OPEC Plus, a virtual get-together after cancelling the in-person get-together in Vienna. Manus Cranny very disappointed.
I'm
by
sure.
the way, yeah, Manus thought he was going to get on a flight to Vienna and, you know, stay at the Ritz and all of that good stuff and then talk about oil. That's not happening. Coming up at the Open, this is happening on Bloomberg TV. We'll catch up with Priya Misra of JP Morgan, Krishna Mamani of Lafayette College, Stuart Kaiser of Citi. Lisa, I know you've enjoyed Stu's research over the last few months. A rally, and a massive month-to-date rally on the S&P 500 and on the Nasdaq. Stuart's point is this is not just about the bond market. This rally this year has been built on good data. And he says when that data starts to turn, you need to turn away as well and run away from this equity market. Until then, stay constructive. Jobless claims about 8 minutes away.
Good news is good news. Bad news is bad news.
Yeah, in Stuart's mind, yeah.
Yes, and the fact that he has to say that tells you where we are in this sort of upside down world, and the fact that that's so controversial to say good news is good news and bad news is bad news gives you a sense of just where we're at in terms of this year. But I am curious to see how he paints that in terms of the tipping point and whether there's any leading indicator at a time where people are saying the jobs market's going to be lagging, that we're not going to really be able to trade the weakness until it's already too late when it shows up in the job market.
Drum roll, JP Morgan and a team. You know, 4,200 on the S&P 500. It's quite a price target. Against the grain, we got 5,100 at Deutsche Bank, 5,000 at Bank of America, 5K at RBC. And there's JP Morgan, bottom of the pile in the investment bank, looking for 4,200 with a downside bias. Their words, not mine. Absent rapid Fed easing, we expect a more challenging macro backdrop for stocks next year, softening consumer trends at a time when investor positioning and sentiment have mostly reversed. You said it earlier. I completely agree with you. Put the number to one side. When you go through the logic from the team over there, it's hard to argue against it.
To me, the big question is tech, because that's been the driver and that's been such a big proportion of overall returns. How much is this just a call on tech? Because the Russell 2000 has done nothing. Banks have done nothing. A lot of the consumer discretionaries, yes, you've got the airlines, yes, you've got, although they're, hit or miss, and then you've got the cruise liners that are doing well, but a lot of the others not so much. So what are they talking about? How much does that composition shift? And increasingly, I mean, remember when we didn't really care about composition? It was just everything goes up or everything goes down. And suddenly now it matters.
Hang on a minute. This month everything has gone up, right?
Yeah.
Energy's had a tough time, but stock market index, bond market rallied.
I'm talking about back in the day.
No, I get that. I get that. It was good times. We're reminiscing, nostalgia, all of that good stuff. All right. Equity futures, positive 1/3%. Jobless claims, 5 minutes away. Neil Dutta, Renaissance Macro, is going to break down all of this with Lisa around a table here in New York. From New York City, good morning.
About an hour until the market opened, about seconds away from some key economic data, including core PCE, the key indicator that the Federal Reserve looks at to get a sense of inflation, as well as initial jobless claims. Taking a look at markets, you are seeing a bit of a pause, at least in the incredible bond rally that underpinned, but not much. We've really come in with yields nearly flat on the day, 427.24. You could see the S&P futures continuing with a lift, up 0.3%. The NASDAQ this month has just been amazing, 11% gain so far year to date. We are getting some of that data coming through. With that is our very own Michael McKee. Mike.
Well, in John Farrow's honor, I'm going to start with jobless claims, 218,000. That's bang on what had been forecast. And continuing claims rise to 1,927,000. Last week, it was 1,840,000. So a slight rise in jobless claims after last week's fallback. Now, we have to caution that a lot of economists are noting this could be distorted by the fact that last week, or the week in these surveys, is Thanksgiving. And so we may see some unusual numbers for that week, but it doesn't suggest that we're having a huge situation with a lot of layoffs and things like that. Personal income up 0.2% after 0.3 last month. Spending up 0.2. Both of those are exactly what was forecast. 0.7 personal spending in the month of September. The deflator for PCE headline is flat, 0.0 after 0.4, which drops the PCE deflator on a year-over-year basis to 3%. That's obviously the lowest since the pandemic began. Core comes in at 0.2, which is what was forecast, down from 0.3 last month, pushes us down to 3.5%. So basically, Lisa, what we've seen is what was expected. Economists forecast jobless claims, spending, income, and inflation pretty much exactly on the nose.
So let's just take you through some of the reaction. Not a lot of drama, as John would say. What you're seeing is a little bit of a decline, a little bit of a dip in bond yields. You're seeing a little bit of a pop in equity markets as they parse through a bit lower than expected, although not significantly so. Inflation read and an inline jobs market that did have at least continuing claims tick up a little bit more than expected to 1,927,000. Mike, when we take a look at this sort of ongoing disinflation and steady labor market, how much can you pair this with what we saw from the Beige Book yesterday, and the sense that anecdotally you are seeing a tightening of the labor market, but it may not be happening in the same kind of way as mass layoffs?
Yeah, what we saw in the Beige Book was, though, the first indication that companies are starting to say they feel okay with doing some layoffs or letting jobs go via attrition. That's a new development, because up to this point, everybody's been trying to hire as many people as they can, or at least hold on to them. So we'll have to see if that gains momentum. It wasn't mentioned as a major trend in the report, just something that had changed. Claims at 218, still very low. Last week was revised up to 211 from 209. So we're not seeing a major trend in layoffs, but we do see more people on continuing claims for a longer period of time. So some indication of softness in the labor market. Now we'll see what happens with income and spending up 0.2. It's still strong, but not hugely so, not like it was in prior months. So we'll see how whether that rebounds or not, and how companies react to that.
We're about 42 minutes away from hearing from New York Fed President John Williams on Friday. Tomorrow, we're going to be hearing from Fed Chair Jay Powell. Citigroup's Andrew Hollenhorst posting that he does have an opportunity to push back on the idea that this disinflation will necessarily lead to rate cuts in the first half of next year by the Federal Reserve, as the market seems to be pricing in. Based on what we have heard, do you agree with Citigroup's assessment that it seems unlikely that he would come out and try to jawbone the market one way or another and push back on rate cutting claims?
I don't think he will necessarily push back on rate cutting claims. If he gets asked about it, he would say, we're not talking about that yet. They're still going to be in that mode. I think Tom Barkin put it well yesterday, said if inflation continues to come down, great, and he's certainly not going to push for a rate increase if it does. But if it doesn't, they should leave it on the table, which is, I think, where the Fed wants to be at this point, because they don't want the markets going too far. The interesting thing is, nobody is arguing with the idea that the Fed is going to cut rates in 2024. The Fed said it was going to cut rates in 2024 in the September dot plot. We'll see what they do on December 13th, but it's really a question of how fast inflation comes down And we're not really talking about, Bill Ackman said the first quarter, we're not really talking about whether or not somebody is predicting this or that time period for the Fed. Look at what inflation is and how fast that comes down, and that'll give you a better idea of when the Fed's going to be thinking about it.
Michael McKee, stay close, please, as you parse through the data, and we'll catch up with you in just a bit to get more details. Right now, we're going to really get into the details of a soft landing nirvana that has come through the data again and again. The words of Neil Dutta, head of economics at Renaissance Macro Research, joining us now, fresh off his Thanksgiving holiday. Neil, does this data just sort of underscore the soft landing nirvana that you really pinned over the last few months?
Well, thank you, Lisa. You're giving me too much credit. I think I pinned it over the last few weeks. But, I do think that the data is lining up, and we're on a glide path now to a rate cut probably by March, frankly. If you look at core PCE inflation, since June, it's up just 2.3% at an annual rate. And there's a lot of disinflation in the pipeline, as we know. We know that, when we look at car prices at the wholesale level, that's declining. We see that pretty much month in and month out. That's going to bleed into core consumer prices over the next few months. We know that rental inflation is moderating. That's going to also bleed into core inflation over the next few months. And the normalization of supply chain should take pressure off of prices for core consumer goods outside of cars. So I think it's highly likely that core inflation is running sub 2.5%, probably on a 6-month basis by the first quarter of next year. And when you think about, the Fed is giving us the playbook. I mean, if we just want to read it. Waller basically told us this week that he's following sort of a standard Taylor rule type of framework. And if inflation slows, the Fed will cut. It really is that simple. Well, I don't want to make a judgment about whether that's right or wrong, but that's what they're going to do.
But
so I think... Sorry, go ahead.
No, sorry to cut in here, but I'm just struck by what you were saying earlier in the year when you were saying people have underestimated how much momentum there is in the economy, and that come next year, we're going to be surprised by the stickiness of the inflation, the stickiness of just what we see in terms of growth. How do you pair that idea and the fact that we continue to get better than expected economic data? How do you pair that with ongoing disinflation in tandem with what the Fed was hoping for, and even then some?
Well, I mean, the economy is holding up, but it's clear that there's more disinflation despite that growth. And, I think the Fed is looking at what's happening with realized inflation, right? So the fact that actual inflation is moderating, that will pressure them to cut interest rates because they don't want to get real interest rates in their framework unduly high, too high. And so I think really that's what it comes down to. And as I say, I mean, part of this job isn't so much what I think they should do, but what I think they will do, and what they're telling us what they will do. If inflation continues to come in like it's been coming in, the Fed is going to respond to that. I don't think it's a situation where they're cutting aggressively. I mean, I think part of the issue right now, Lisa, is that a lot of folks aren't used to the Fed just surgically cutting interest rates. I mean, it's usually they do a lot or nothing at all. But I think what we're talking about for next year, for 2024, is really a recalibration of monetary policy. Not unlike, frankly, what we saw in 1995, where the Fed came off of a year of very, very aggressive tightening and cut rates a few times, trying to fine tune their monetary policy, which frankly I think they can justify that based on the inflation data as it's going to come in.
Neil, I know that earlier in the year you were also talking about how inflation is going to be higher for a longer period of time. Do you still think that?
I mean, I do, but the question is around the time horizon. I mean, I think that the economy is growing above trend. That's ultimately going to have some effects on prices. But there is a lot of disinflation in the process and in train, and the Fed is going to respond to that. The issue, frankly, is does the soft landing enthusiasm today, does that reignite inflation later? I think that that's something the Fed should keep in the back of their mind. And frankly, that may be one reason, kind of puts a ceiling on how many cuts they can do. But I do think we have to get through this period of disinflation first. And I think the Fed is going to react to that disinflation, which is why I think they'll cut interest rates. And they'll probably front load the cuts and sort of get it out of the system quickly. Look, they're already telling you that they're going to cut rates. I mean, they were at 4 in June, as Mike mentioned. They went to 2 in September, and they might signal that a pause in December and pencil in three cuts for 2024. I mean, that doesn't tell you when they do it, and that's why I say I think given the glide path and inflation that we're likely to get, they probably do it sooner than later.
Neil, I'm curious, from your vantage point, a lot of people have been saying it's going to be the bond market's dream and that you're going to get an ongoing rally in bonds, that will tee off an equity market rally. Do you agree with that type of recipe, or do you think that it's not so simple, especially if there is this longer term question embedded in bonds of what the new neutral rate is, that actually solid inflation, but not overly hot, a central bank that's surgically cutting, that's really positive for risk, but not necessarily on the other side for bonds?
Well, I mean, I think it probably may weigh on longer term rates, obviously, right? I mean, but again, for the stock market, I mean, it's ultimately an environment where companies can make money, which should continue to help, stock prices go higher.
Neil Dutta of Renaissance Macro, thank you so much for being with us and for the incredible phrase, soft landing nirvana, which we do keep using again and again, because it does so perfectly explain where we are at a moment where suddenly people are piling into bonds, and that is supporting the equity market. Right now, we continue to see that support to equity valuations after economic data coming out, basically in line with expectations. Just to go through the numbers, if you are just joining, initial jobless claims came in at 218,000, exactly bang on what people expected. A little bit of an upward revision, but no drama in terms of the prior month. Continuing claims did come in a little bit higher than expected. Personal income and spending both came in basically in line. Real personal spending a little bit higher. And interesting that the PCE deflator, this is sort of one of the key indications that the Fed looks at to understand where consumer prices are headed, came in just a tick below expectations, 3% year over year from the expected 3.1% and down from 3.4%. That bleeds into the market with bond yields basically going nowhere after an incredible rally, having been up about 4 basis points earlier. They've gone back to that now, 4.2955 on the 10-year. S&P futures up 0.3%. With us, we do still have Michael McKee of Bloomberg Economics, our correspondent, our fearless Fed correspondent as well. What are you looking at when you parse through these numbers that stands out to you?
A couple of the most interesting things. Wages and salaries in October are the lowest in quite some time, just up 0.1% after many months of 0.5% and 0.4%. So we are finally seeing a deceleration. Of course, standard caveat, 1 month does not make necessarily a trend, but this is what the Fed has been expecting. So it will be interesting to see if that continues, because the real drop was in private industries and in manufacturing, areas where people get paid more money. Those have fallen. Manufacturing was flat and private industries just up 0.1%. Both were up 0.5% in prior months.
Is this basically the playbook, that this is sort of the first signs of a squeeze that then kind of get carried out in more aggressive actions like cuts? Is this sort of how it typically happens, or is there still nothing typical about this cycle?
Well, there's nothing typical about this cycle, but if we are going to go into that kind of environment, this is how it would begin. It doesn't necessarily mean that we go down that slope all the way. For example, we've been talking quite a bit about whether or not Americans have exhausted their pandemic savings. Well, the savings rate went up in the last month to 3.8% from 3.7%. So there's still a lot of we don't know out there.
That's a good way to say it, especially with real personal spending coming in higher than expected. Coming up, someone who has been a long-term bond bull, made incredible returns during the era of zero rates, and now is facing off what he thinks is another massive bond market rally. Lacey Hunt, Executive Vice President and Economist at Hoisington Investment Management.
I think it's going to all be about rates, and I think that you've gone through this sort of incredible whipsaw where the long end of the curve was a one-way short bet. Now it's a one-way long bet. I think we're going to end up with the 10-year back in that 4.50 to 5% range. And I think the economy's okay. I mean, I don't think we're pre-recession.
That was Michael Schall, CEO of Marketfield Asset Management, just a bit ago as he laid out what he sees as something more of a trader's market, with equities still kind of hanging in there as we are not in some sort of recession. Equity certainly hanging in there after a pretty amazing month, at least when it comes to some benchmark returns. Certainly in equities, you look at the NASDAQ, the best returns that we saw since earlier last year, up about 11%. S&P futures up about 0.4%, adding to the gain that we've seen of about 8% so far this month. This all on the heels of a bond market rally that has been the biggest rally for U.S. debt going back for a month since 1985, which is a reason why I am so thrilled to speak with Lacey Hunt, who is Executive Vice President and Economist at Hoisington Investment Company in the 54th year of his career, someone who made a name for understanding financial repression, for understanding low rates based on low growth and low inflation, and who has some unique perspective on where we are right now. Lacey, so great to have you on the show. What do you make of what we just saw for the month of November, the biggest bond rally in U.S. debt going back for a month since 1985?
I think it indicates that the economic risks on the downside have increased at a time when most Americans are suffering hard times. And in the past, when this has happened, and based on economic theory, the bond market should rally, and that's what happened.
We're looking right now at hard times when it comes to anecdotes, when it comes to the beige book, when it comes to sentiment in certain quarters, not so much when it comes to spending. We just got real spending that surprised to the upside. We saw an incredible Black Friday tally. We saw record Cyber Monday sales. We're seeing ongoing strength in the labor market. Where do you see these signs of something that looks more like a hard landing than the soft landing nirvana we were just talking about with Neil Dutta?
Well, there's two equally important concepts in economics. There's what we spend and then what we earn. And there has been a massive dispersion between the two. In the last 4 quarters, gross domestic income is actually down 0.2% in real terms, whereas real GDP is up 3%. We've never had such a wide gap. And the time that we had a gap that was similar, but not nearly as large, was the third quarter of 2007, and the next quarter we were in a recession. So there's an amazing discrepancy there. Another discrepancy is that we are seeing gains in employment, but the work week is being shrunk. And if you look at the hours of all persons worked, it's actually declined over the last 6 months, as the work week is more than negated the gains in employment. And if you look at how people respond to the outstanding University of Michigan survey, they say they're absolutely wretched, and they should be, because for most of our people, incomes have fallen badly behind inflation. And in fact, the University of Michigan readings for several months have been below where we entered the recessions of the post-war period. There are a lot of problems that this economy faces. In addition to that, we have extremely restrictive monetary policy, and fiscal policy is in a non-sustainable situation. If one looks at monetary growth on a 1, 2, and 3 year basis, we see that all the stimulus of 2020 and 2021 has been eradicated. Historically, my preferred measure of money grows at 3% per annum. It's currently contracting at 1% per annum over the last 3 years. And another totally contra-normal cyclical development, bank credit has declined over the last 1, 2, and 3 years. That's totally abnormal. Yeah. Because bank credit is a lagging indicator. It doesn't typically peak until the economy gets into a recession. And another monetary indicator, which us old timers use, is known as the Wicksell effect. Wicksell, I should say, for the Swedish economist. He looks at the relationship between nominal growth and market rates.
Yeah.
And if you use the average of income and spending, the Wicksell effect is got the market rates 100 basis points over the natural rate, which is a restricted condition.
Lacey, forgive me. I want to dive in. You're talking about a lot of things, and I want to unpack some of it. I apologize for cutting in here, but there is this question.
Right everybody.
There's a question here about when you talk about the fiscal picture and how it feels unsustainable, and then you're talking about very restrictive monetary policy. Is it clear that the trajectory is back down to a 10-year yield below 2% or below 3%? Or is the 10-year yield that much more confusing because of the conflicting signals from both monetary policy and a fiscal policy that faces off with a whole host of bond issuance?
I think that interest rates are lagging economic activity. I think money supply growth. I think that the trends in these various critical monetary variables lead. The financial cycle leads the business cycle, and the business cycle leads the labor and the price cycle. And this is a sequence that's been well worn out over time. The financial cycle peaked in the first quarter of the fourth quarter of 2021. The normal lag is 5 to 9 quarters. That's where we are right now. We're in the 8th quarter. These monetary effects are very, very profound. Fiscal policy is also not sustainable. The chairman of the Federal Reserve said that just recently, and he should say that. We've created a situation now where our net national saving is negative. In other words, the government budget deficit is greater than private saving and the foreign saving. And in fact, we just experienced the 3rd consecutive quarter of negative net national saving.
Yeah.
And without saving, you're not in a position to have investment. Without investment, you're not able to effectuate an increase in the capital stock.
So
and without an increase in capital stock, you cannot raise the standard of living. But the economy has cyclical problems and has secular problems.
Just quickly here, Lacey, I'm curious then what your new projection is. How much further you think the rally has to go that we just experienced this month?
Well, we're not in a position to give you an individual rate, but I can tell you that Lexington Management has an 18-year duration, which is a very strong statement that we expect a substantial decline in rates over the next several years.
And do you think this is going to come on inflation going substantially lower? Are we going back to the same kind of inflation that we saw before the pandemic?
Yes, one of the very interesting things is that this year we've experienced a nearly 600 basis points decline in the inflation rate, while the economy was still expanding, at least in the GDP terms. That doesn't happen. The inflation rate has fallen by 600 basis points in the past, but never when the GDP is rising. And if we get any type of mild recession, if you look at the average inflation rate since the recession since the 1950s, the inflation rate averages 1.3% at the low. There's a lot of restraint in the system. Restraint is moving into the system even here in November. The Federal Reserve has liquidated $60 billion worth of permanent reserves. We're seeing actually now a nominal decline in commercial and industrial loans and some of the other critical lending categories. This is an indication that the restraint is moving through the system. And these have effects, especially at a time when so many people are doing so poorly.
Lacey Hunt, thank you so much for being on with us. Lacey Hunt of Hoisington Investment Company in his 54th year in the bond market at a time where people are wondering how much can this bond market continue to rally. The best, biggest U.S. bond market rally going back to 1985 at a time when people are talking about rate cuts and what's next for an economy that has been highly uncertain. Right now in markets, we can see a lift to equities as we head into the final trading day of November of 2023, up about 0.25% for the S&P, 45.70. Just amazing that would have been a year-end target for 2024 for so many people if they wrote their outlooks in November. A bit of euro weakness after a weaker than expected European inflation data, raising the prospect of possibly getting ECB rate cuts earlier in the year and really just throughout next year. 10-year yields up now, creeping a bit higher, up almost 6 basis points, 431.09. Still lower, though, from some of the recent highs north of 5%. Coming up on Bloomberg Television at 3 p.m., Lisa Shallett of Morgan Stanley Wealth Management as we get you through this day.